Phone. Anybody? Okay, we'll find you. So, good book to read, by the way, if you haven't read it. Our next panel, we have a series of investors, and my good friend Nathan is moderating. Nathan is the founder and CEO of Founder Suite, which helps you with your fundraising and keeps you organized and does all kinds of other cool stuff. Jennifer Lee is at Learn Capital. They do ed tech investments. Ben Nazarin is at Canvas. And then again, we'll have Eric Miller, who's now leading up Hyperspeed Ventures. Everybody come on down. Welcome. And Yellow. Where's my fills?
Right.
Did you do this in the right order? No.
Well,
I think I reversed it.
nice. All right. So I'm going to be moderating you guys today. Thanks for coming back for lunch. So I think we should just start off, go down the line and kind of introduce ourselves and talk about your funds and what you do. And I'll just do my quick intro. I run Founder Suite. You can probably guess we're a software platform for startups that are raising money or doing their investor updates. We launched about 15 months ago, and startups have raised $200 million on the platform, so we're getting some good momentum. Ben.
So I'm Ben Naris, and I'm a general partner at Canvas. Canvas is the go-forward group out of Morgenthaler. A fund started in 1968. We're now on the second Canvas fund, about $500 million under management. Classic Series A and B, and very occasionally seed, Sandhill style, boutique venture firm. Before that, I was a seed investor for about 10 years, starting in 2007. Funded everybody from Lending Club to Zenefits, all kinds of really interesting, phenomenal entrepreneurs who've had interesting times lately. And I was an entrepreneur for 25 years before that, took my company public back in the bubble in the e-commerce space.
Cool. Jennifer.
So I'm from Learn Capital. We're an education technology-focused venture capital fund. We've been investing in tech since about 2009. On our third fund, we've invested in all ages and stages of learning, so anything that makes someone a smarter learner anywhere in the world. Companies include Edmodo, Coursera, Bridge International Academies, Andela, VIP Kid, Class Dojo, kind of Learner Skill, General Assembly, and Udemy. So that's basically us.
Awesome.
My name's Eric Miller, and I'm the founder and managing director of Hyperspeed Ventures. We're investing in what I call radical breakthrough technologies and emerging technological megatrends. And that's so I've done investments in quantum computing, genetic engineering, and like space tech so far. I also will make investments. It's my own fund. It's a $10 million fund. So I'll invest in things I'm also passionate about.
Awesome. So we'll start off with a couple easy ones. Kind of give us your profile investment. How much you typically invest? Actually, let's start with you, Eric, kind of go down the line. How much, what stage, and what do you look for in terms of traction or other key identifiers?
So I try to stay as early stage as possible. So I'll invest anywhere from pre-seed to Series A. And I'll invest anything from as low as like $25,000 to $250,000. And what I look for, it depends on the stage of the company, and typically I look for obviously really, really large markets. And
some of your categories, I looked briefly at your portfolio, are bioengineering, quantum computing, robotics. Are you looking for traction, or are you looking for someone who's got an amazing quantum computing idea? And how do you identify winners in those nascent categories, I guess you could say?
Sure. So I mean, I typically don't invest in ideas alone. So there needs to be something that's built, an amazing team, and I just try to stay sort of at the precipice of these emerging trends and find the really great teams that are sort of coming out of that. And I think that it takes a while for a lot of these trends to develop, so it's actually pretty easy to recognize them if you're paying attention.
Okay. Interesting. And Jennifer, how about you? What you guys are seed and A?
We're so sector focused. We're very stage agnostic, and we're kind of not the typical behavior in that sense. We do everything from seed. We've actually even done incubation ideas, typically when we have a very credible founder at that point. And then because we're so sector focused and really the entrepreneur just wants someone who like rocks education on, understands intricacies of it, can commiserate with them about it, that we actually invest all the way up to about Series C. So
Okay.
we've written checks as small as 25,000 and gone all the way up to, low double-digit millions. And that's just because entrepreneurs they value having someone who really understands education, regardless of what stage they're in.
And how much traction do most of these startups need to have before coming to talk to you? I mean, you're investing pretty early. Are you doing pure idea play stuff? Or are you looking for product market fit,
Yeah, it really depends. It depends on, again, like I said, if it's idea stage, then we want to see a really credible founder with a just great, strong track record and familiarity with them as well as the concept. And then, be honest, it has changed as over the last years. I would say even at the seed level, even within education, I'm sure you see this trend elsewhere, that the level of traction and the progress is more these days.
The bar is rising.
The bar is raising, and then, if you're in K-12 selling to schools, you better have a lot of traction before you.
Interesting. How about you, Ben?
So, there's a pretty big range. We're primarily focused on A and B, but there's always going to be outliers. So the financial answer is that in this fund, we've already done one $100,000 check, the smallest the firm has ever written, which I did because I was really compelled by an individual raising a seed round, got there sort of late, but really believe in this person and want to see how he evolves over the next year, to something we're in term sheet on right now where we're writing a $25 million check. Now that's a staggering range. So what's the norm? The norm is Series A, call it anywhere from 4 to 8, maybe 4 to $10 million, and Series B, probably 8 to 12, 8 to 14 million dollars. We're normally going to allocate between 15 and 20 million dollars to an investment over its lifespan, and then look at things within that in terms of how much it's going to take us now and how much it's going to cost over time. At the end of the day, though, like every other venture firm that we compete with, very ownership centric. So, in a Series A or B, our goal is to get 20+% ownership in the company. In a seed round, which is, to tell you how rare seed is for us, in the last fund, over a deployment period of 3 years, we did 2 seed deals, of which I did 1.5. In total, we did 15 investments. So it is a very small part. So when you think about what do we look for, what do I look for, because every person is different, I always need 5 things to make an investment, and then I need 6 or 7, depending on the stage. For every investment, it's people, 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 a great idea, and a huge market if it works. I've found that generally speaking, betting purely on people that don't have good ideas, that don't have big markets ahead of them, is not a great way to make money. There have been forward fumbles over time. Twitter's probably the preeminent example of that. But for every Twitter, there's about 4,732 where it didn't work out, and that forward fumble turned into nothing, and the company just got hired away. So that's a seed view. At Series A, add traction. And at Series B, add a lot more traction. The velocity at which you are accelerating is important, but it is really difficult, except in extraordinarily rare instances, to look at a Series A where it's all about the concept. At that point, you should have found product market fit, you should have found customers, you should be getting paid, unless it's a business that's purely based on the velocity of growth of the users, which there are still some. And lastly, I'd say the entire metaphor of Series A, B, C, and seed has changed tremendously, as you sort of alluded to a little bit. Right now, seed investors are competing with Series A investors for rounds. They're bidding at A's. They're trumping their own seed deals as A's. Seeds are getting raised at $4 million. I've seen seeds raised at $13 million. I've seen them higher. How do you call those a seed? I mean, they're Series A, except there's no board seat, there's no governance, and there's probably not even an equity term sheet. There's probably just some sort of note. So it varies, but the center, people, 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 great idea, and a huge market, if it works, is going to be true for all of it.
Interesting. And how many deals will you do this year, do you think?
I mean, if I do 1 Series A year, that's about the right pace. Now that we are willing to do a little bit more in seed, there could be anywhere from 1 to 4 seed deals there. But
4 seed deals, 1 Series A would be a typical year for you?
A typical year for me would be 0 seed deals and 1 Series A, but going forward, I believe there's the chance to stretch to 1 Series A and 4 seed deals.
Okay. And Jennifer, how many deals do you think you guys will do?
So that's about, I would probably say it's closer to 4 seed deals, 1 Series A.
Okay.
2, actually. We're fairly active.
By the way, this is on a per partner, but I'm just talking about as a partner, not as a firm.
Okay.
Obviously, with 4 GPs, you're going to do more than one Series A deal.
But that's still 10, 12 deals a year, maybe. Top four partners.
Oh, our whole fund will do 15 to 20 deals over the next 3
Okay.
years.
Okay.
And that's deploying $300 million out of that fund.
Interesting. Eric, how about yourself? Are you spreading a lot of smaller bets? How many deals do you think you'll do 2017?
So around 15 to 20, although I just did 5 last month, so.
Okay.
Yeah.
Dude, you just covered 2 years of my work. Take all those deals and retire for a couple of years.
Interesting. So, I think this is all interesting stuff, but what most people in the audience want to know is how do they get in and pitch you guys? Take it from a couple different angles. One is how do you, where do you get most of your deal flow? Are you sourcing from incubators, accelerators, et cetera? And then the other kind of angle is advice for these guys. And a lot of the folks in the audience, I think, are coming from outside Silicon Valley. A lot of them are maybe even from foreign countries. I've been talking to people outside. And a lot of them are pretty new to Silicon Valley. So, two-part question. Where do you get most of your deals from? And then advice for folks in the audience to get in with you. And Jennifer, maybe start with you.
Sure. Given that we're so sector focused, I think we're again a little bit different in that most of our deal flow is inbound. We have more deal flow than we can handle. A lot of it comes from trusted intros. Our current portfolio companies, CEOs, management are actually an excellent source of new deal flow. They make great recommendations. We do have a website. People email in off of it. I think for every 100 that comes in, we'll take one. But with that said, one of my investments last year was one that came in off of that website. And as soon as he emailed me, I said, I know exactly who you are. I've actually been tracking you.
Oh, interesting.
Please come in and we'll talk at stock. And he was from Croatia. So
Very interesting.
yeah, we actually did 2 investments outside of probably a little more than 2 investments outside the US. And on that front, kind of just knowing who the investors are in this space and being proactive. I think you have to be if you're going to do a cold email, make sure it's worthwhile, right? The reason why we only take 1 out of 100 is because 80% of them are saying, hi, this is me, I want to talk. Like, I don't have time to look up who hi, this is me is. So if you're very succinct, you give me the exact high-level details, key traction, whatever is really important to get across who you are, what you're building, and what's the vision, then I might actually be interested in looking up who you are.
Any of you are taking let's take it in its funnel. Have you ever done a deal from a cold email, or have you ever even taken a pitch meeting from a cold over the transom?
I have. I remember distinctly regretting it once. It was truly one of the worst pitches I'd ever seen. I couldn't understand how the person had gotten into my office because the filter in Silicon Valley is a relatively fine mesh. And I thought, how did I get this one? And then I realized it was a LinkedIn cold outreach that for some reason I decided to take. So generally speaking, I don't know many folks that do take that. By the way, I would assume that in most cases it's 1 out of 100 that you even look at having talked to you. Because one thing everybody should understand is that I just came from another panel on a similar topic in the mobile space, and there were 5 venture capitalists, and they basically asked us all how many deals we saw. And the answer boils down to, I will see 1,000 pitches a year. And you already know from my prior discussion that I will do 1 deal a year. So that's not a 1% conversion rate, that's 10 basis points. Right? So and those were relatively filtered deals. Now it's made up of all the accelerators and incubators and demo days and one-on-ones and TechCrunch disrupts and all of that. But it's tough. So getting in in order of priority, if you have a founder that somebody has already invested in before, that is your absolute best door into a firm. Because 1, no one's going to refuse one of their founders. At least I can't imagine anybody would. That would be asinine. 2, that founder probably has a pretty good understanding of the firm and the people inside of it and whether there'd be a fit. So if they're going to be candid and honest with you, they're going to say whether you're worth having that conversation or not. Worth is the wrong word. Whether there's a good mesh. Because not everything should raise venture, and not everybody should assume that the partner they've heard about is the right partner for them. The relationship between you and your partner is critical. So if you have somebody who already knows that partner, they're going to be a great conduit and a great sort of person to help you calibrate. The next step after that would be somebody that is respected in the seed category, as an example for a Series A guy, or otherwise known to us, quote unquote. Then you get sort of stuck in what I would call, with appropriate respect, the service layer, accountants, lawyers, et cetera. They are a frequent source of referrals with a relatively low conversion rate to meeting, partially because their filter is not meant to be explicitly tuned to mine. It's more their clients. If it's a client, they're going to help in every way they can. And then after that, the idea of going in over the transom is you've pretty much given up at that point. You've exhausted all possible ways to find a warm in. Because, by the way, if you haven't exhausted all possible ways to find a warm in, you just made a huge mistake. And that's reflective of your pattern. And so now, maybe you are new to the community. I get that. That happens a lot. There's a lot of accelerators and incubators that get people that are new to the community explicitly because they don't have the network, and they want that demo day as a time to stand on stage. One of us.
Who is that? Who's making that?
I think now we're all good.
No, that's really good. So, kind of continue on that, and maybe Eric, this is for you. You know, the Y Combinator's, Techstars, I mean, I think we do a lot of marketing to accelerators, so I think at one point I counted almost 2,000 accelerators globally in our database. Do you guys get a lot of deals from demo days and from accelerators, and is that a good channel to get into you? Do you go to the demo days?
Yeah, so I've a couple of the startups that I'm like really happy with have come out of YC. I just led a seed round that was a YC company, and they were like massively oversubscribed. I mean, it was, you know, so that was pretty cool. The quantum computing company came out of YC.
Okay.
So I mean, they're, you know, they have a great filter. They create really, you know, high quality startups. You know, but a lot of the companies that I end up finding are more because I'm interested in. So it's like getting the cold emails and getting you know, sort of inbound is not so successful for me. I'm usually not happy with what I'm seeing. I do try to look at every single email I get in, though. Sometimes it can be very challenging. But you know, I will meet with people if I'm interested. I try to be as open as possible with, you know, limited time being a constraint. The thing that I do, though, that I think is I hunt for startups that are emerging out of certain sectors that I'm interested in.
Hunting where? Where are you hunting?
On the internet, everywhere.
Okay.
You know, but asking my network, asking people, you know, looking for companies that haven't, you know, necessarily had a lot of exposure.
Broken out, yeah.
Not necessarily in the Bay Area. I invested in a company called Unicorn that's based out of Seattle that was founded by, you know, previous Microsoft Ventures.
It's kind of a presumptuous name for your startup, Unicorn.
Yeah, well, it was in the esports space when esports was about a $100 million market. Now esports is growing faster than any analyst has anticipated. It's like $1 billion this year. So, you know, and honestly, I found out about that company because I'm friends with the founder, but I didn't even realize he was leaving Microsoft Ventures to start it. And he posted on Facebook, and I saw the post, and I was like, dude, you have to let me in the seed round. And so, you know, I mean, so it just depends. Like, it depends on the specific, but you know, they're doing amazingly well now. Like, you know, raised a great Series A, and they're growing globally. They have offices all around the world. So it really just depends. You know, but I like to hunt. I think hunting I've found the best deals that way.
Interesting.
You know, make one comment on if you are going to email. And by the way, this is a great point. Like, we're all hunters. You know, you guys are hunters because you're going to, you know what this is for you and for us? It's a game of frog kissing. You're going to kiss 1,000 frogs looking for the one that turns into a prince and gives you money, and I'm going to kiss 1,000 frogs looking for one that turns into a prince as the entrepreneur that sees value in me and that I see value in that I want to fund. So we're both in the same game, just on opposite sides. So it's somewhat interesting for me as a guy who's an entrepreneur for 25 years to sort of sit back and look at where I get to play, because, you know, 97% of the time you're in this position of people coming to you and aggressively wanting to spend time with you, and et cetera, because they're looking for the money. And then that makes you feel whatever it makes you feel. But then you find the thing you want, and you're fighting like a dog in a pit against 7 other venture guys or gals to fund that company. And you're now back on the opposite side of it. So it's just it's like diving into ice cold water and then jumping into a boiling lake. If you're going to do a cold outbound email to somebody, And if you can, and look, the emails are posted. I think my email is ben@canvas.vc. Feel free. I do read all my emails. It's a nightmare. I'm up all night doing it, but I don't like other people to read my emails. So if you're going to reach out, the two things I'd say is, one, an elevator pitch that is one line long. The very few number of times where I've seen something I've said, okay, let me learn more, is where it was very succinct. You know, we're enterprise SaaS for industrial IoT data output into blah, blah, blah. I don't know, whatever. Okay, now I know what you're doing. I can decide if that's relevant to me and I can go forward. So just make it succinct. I'm not reading 6 paragraphs. Sometimes you get these long, long, long emails. I will read the first line. All people will do this, whether they admit it or not, and decide whether I'm going to read anything else. So get it done in the first line and then go from there. Secondly, no response means no thank you. I'm more than happy to read an email that comes in, but I did not request it overtly. I did not say I can't see anybody except the first line in the audience, but like, you, send me this email. If I'd said that, I owe you a response. If I did not, then my feeling is I will read it, and if it's relevant, I'll respond, but if it's not, I'm going to hit delete. So that's fine. Your cost was hitting the send button, because you're sending it to me and a bunch of other people. Just understand that that follow-up email you send and the one thereafter, what ends up happening is on the fourth one, it is, thank you so much, but it's not a fit for me. I thought that was understood. Goodbye.
For the record, I've emailed Ben and not got a response. So,
Really?
I'm pretty sure.
Damn.
And then just to put some numbers around it, like when we raised our seed round, I actually pitched like 200 people, ended up with 1 seed fund and 10 angels. But you know, you do that math, it's 5% of pitches turned into something. So interesting. So let's talk about that competitive deal scenario. You know, kind of back to the other side where you're hunting, you're chasing, and you're competing against 5 other VCs. Think of the most recent competitive deal you were pursuing. How did that startup create that heat around their deal? Do you have any insight? Start with you.
So I'm working on one right now that's in exactly that sort of situation. They've got 5 major firms that want to fund them, plus a bunch of seed institutions. I've got a great relationship with the entrepreneur, so I'm quite hopeful that we will be able to participate and add some value. The question of creating heat, there's only 2 speeds in fundraising, glacial and rocket ship. If you spend a long enough time in glacial, you may find your way into rocket ship, where everybody starts to care. But one of the things that troubles me in general, you know, you mentioned YC. So I've funded 6 or 8 companies out of YC over the last 10 years. I've been going to Demo Day, I think, since version 2. They and others tend to be a little bit obsessive around game theory. And this troubles me a great deal because, one, I get that you're smart and I get that you understand the concept, and I'm really happy about that. But if you're using on me, that's not good.
Can you maybe elaborate on what you mean by that?
Well, so, you know, there's often a overly significant concentration of time and effort on managing the process in a way that creates the illusion of something. You know, like, here's a great quote. Oh, you know, we're oversubscribed already, but I thought I'd take the meeting with you just because we only want the very best investors, so we're considering every option. That could mean everything that was just said, or we don't have a single offer, we don't have a penny, and I'm desperate to get money in. You won't know because you'll hear the same thing from all the entrepreneurs that came out of certain types of training. And so it's a little bit about gaming the process, which I despise. Because think of it this way, you know, I'm married, I'm very happy to be married, I want to stay married. Imagine that it took me 9 months to get the first date with my wife. Imagine that instead of spending 9 months of hard work to get my first date, I found a trick to trick my wife into marrying me. I used game theory and managed to work it all out. I'm super hot and I got a lot of people who want to get engaged to me. I know if you would just marry me, wouldn't that be great? Okay, and now we're married and we're going to spend the rest of our lives together? Disastrously bad. Right? Like, you got to start on a strong footing. So I sort of push back against the concept. The heat brings itself. And unfortunately, there's no way. Many times entrepreneurs are entirely surprised by the amount of heat or lack of it around their deal because myopically they're very focused on what they're doing, as they should be. And they don't have a perspective of what the outside view of that could be at that. Sometimes it's timing, serendipity. You know, there's plenty of examples of things that, there's a great saying, being too early is the same as being wrong. You know, in venture, you have to be too early, but by the right amount to not fail. You have to be just early enough so that, you know, you raise your seed or your friends and family round so that you can hit the point that everybody else understands that it's hot just in time. So you can never do what's hot now, you have to do what's hot later, and you're the ones that are going to create that. Look, I think you should provide an honest representation of what you are, who you do, and how you do it. I was just coaching an entrepreneur as I came in that I'm a seed investor, and he's got a term sheet from one player. He's got 2 other players jerking him around, not giving him an answer, but doing all kinds of diligence. And he's like, what do I do? I'm like, you be honest. I have a term sheet. It's a reasonable term sheet. I need to take it if you're not going to give me an answer. You have till Friday, and then I'm done. Here's the problem, though. That's fine when it's honest. A lot of entrepreneurs will do that when it's not. And then when the person senses it just a little bit, they just wait till Monday. And on Monday, miraculously, you call them back, and then they know for a fact you were lying. And that kills the relationship. So just be really careful about balancing your own. You are looking to get married. At least if you're doing Series A. At Seed, sometimes you're just looking at building a harem of dates. But at Series A, this person is on your board, and that meant to, I'm going in both directions. Maybe you're building a harem of males. I assume that's still called a harem, to be fair, right? I'm happy to be part of somebody's harem if it's a seed round. You want to find the person you can be with long term, and if you built this up using artifice, that creates all kinds of self-inflicted wounds you're going to struggle with for a long time.
It's, so I think that's all good advice. Maybe Jennifer, if you want to expand on that at all, or, part of where you left off there is the guy that has one term sheet. You said, be honest, you've got one term sheet, 2 other guys are jerking you around. But from my experience, it's, 80% of the work to get that first term sheet, right? That's the hardest thing to get. So I don't know, Jennifer, when you're working with some of your portfolio companies raising their next round, how do you get that fire lit, right? So they're getting a term sheet that they can use as a catalyst. I don't know, any other additional tips on kind of how to get momentum or heat around a deal that you've seen work either with your companies or work on you?
Work on us. No, I mean, I would agree and reiterate what Ben says. I don't think you can do anything that's not sincere, right? It's not authentic. And if there is authentic interest, it will surface. If there is authentic interest, then you can do things such as creating points of action, right? Like forcing people into a point where they need to decide yes or no. And I think that's an important skill to do, but you can't do that without authentic interest involved.
Mm-hmm.
I don't know that there's, honestly, I don't know that there's much more to add to it than that.
If if someone's reaching out to you and they have a term sheet and they say we're running a process and we're, looking to close this round by June 6th, does that get you to move faster, or do you run on your own timeline?
I think given our level of interest, it depends on how we respond.
Sure.
Right? So if you say it's hard deadline Friday, let me know yes or no, and we really want to be on this deal, we will make a decision by Friday. Mm-hmm. If we are somewhat on the fence about it, or we're still trying to better understand the opportunity ourselves, we'll potentially let that timeline pass and see what the response is after Friday, and to see whether or not there's still potential.
This assumes, by the way, that one of us is already working on the deal. Mm-hmm. Sometimes you have an entrepreneur that will use I have a term sheet as a trigger to starting a conversation, which I find incredibly difficult because it does take a certain amount of time. I mean, when I used to do seed, I would often, in fairness, do exactly that. If I had an entrepreneur that got an unsolicited Series A term sheet from somebody that I thought was good but not perfect, I would reach out to people I thought were perfect and say, look, I know it will be tough, but I've got an entrepreneur that has a term sheet. And by the way, using people that can back channel for you is entirely rational, reasonable, and fair. Because it's a lot easier when I was a seed investor for me to say to my friend, I can't tell you who, but you'd respect this player, do the work now so you can make a decision, than for the entrepreneur to say it. Because in some ways, it's not that you're giving up a confidence if you haven't signed it yet. If you've signed it, then that's a different issue. But you don't want to go in with, as a starting point, hey, I've got a term sheet from Bob, but I'm looking for the best possible deal. I'm shopping it around. Can you guys work on this really fast and get it done? That makes it, there's lots of reasons why that's bad.
Well, I think that the main kind of also takeaway from what Ben's saying is that you should, or at least I appreciate starting conversations with entrepreneurs before they're raising, right? Mm-hmm. Like, I think it's
How far in advance? So if someone wants to raise money from you, when should they start a dialogue with you, and what should that dialogue look like?
I think that I'm open to a dialogue. It doesn't have to be 6 months before you're raised, or it doesn't have to be 3 months before you're raised. I'm open to beginning a dialogue with anybody that I think is creating an interesting business at any point in time, and I like the ability to get to know the entrepreneur, understand what their goals are, and that also helps me, right? When I take it to the other partners and just say, are we interested in this deal? Yeah, I've been talking to this entrepreneur for 6 months. I'm talking to them for a year. They said they were going to do X, and they did X. I think that's a very helpful point. And I think it's much easier to have that discussion if you have an existing idea of what this company is than, I just met this entrepreneur, they have a term sheet, they want a decision by Friday.
Sure.
Most likely that deal will not get done.
Should that entrepreneur be sending you like a monthly update or just giving you a buzz every couple months and with a, status update? I don't know.
Yeah,
The
I get added to monthly, quarterly, that's fine, updates.
It's a delicate balance, though, because, I used to take a pretty polar opposite view of this when I was doing seed. My attitude was, don't talk to people until you are interesting enough for them to care, right? Mm-hmm. Because if you go in, let's say, have a coffee with a traditional VC and they're not ready to bid on this, the likelihood is they're not going to be interested in considering bidding on it for at least another 6 months, because that's how long it's going to take before they really care whether you've made any progress. Because if they believed in the progress you said you were going to make, they already would have shown more interest. We all want, this is the difficult thing, we all want to get to know the entrepreneurs early. The problem is the word "the." Okay, it's not, we want to get to know 1,000 entrepreneurs so we can figure out which one we're going to invest in and spend lots of time with them over the next 12 months, because that's physically impossible. It's we want to be lucky enough to have done the work so well that we found the entrepreneur that ultimately will be the awesome one and spent time with that person. Incredibly, incredibly difficult to do. 2 quick stories. I had a friend of mine that when I was providing seed deal flow for Series A, half the companies I funded raised Series A, and I was usually the introducers of those. And he said, Ben, this is great. We didn't have a lot of time here. They did the deal, but I'd love to get to know your entrepreneurs earlier. I'm like, no, you don't. You want to know the entrepreneurs the minute they're interesting. You want to know the entrepreneurs you want to fund backwards in time. Because otherwise you'd come to all the events I do and meet all these entrepreneurs early and spend all this time. You're not going to do that. You're not going to get to know 80 entrepreneurs so you can fund one of them. It's this mental gyroscope that traditional venture folks do more than seed, I think, of, oh, why didn't I meet them earlier? They forgot about the other 999. They said, why didn't I meet Bob, the one that I funded? What I will tell you is, when I take a meeting, my goal is either to give somebody a pass in the meeting. If there's a reason I can't fund somebody, I want to say that in the very first meeting, because I do not want to waste their time. If I scheduled an hour with them, I will give them the hour. If 15 minutes in I know it's a pass, I will tell them and offer the rest of the time for whatever they want. Curating their deck, giving them feedback, talking about life experiences, buying them food, doesn't matter. They're entitled to the hour. I can't say yes in one meeting, but what I can say is I want to spend more time with you. And that can move on to multiple meetings and meeting the partners and thinking if we can get there. The highest level beyond doing a deal for me, though, is I actually want to spend time with you again. I want to take you out to lunch once a month and stay in touch. Right now, based on the last 18 months of work, I have 4 people on that list. 18 months times 1,000 a year means out of 1,500 companies, I'm taking 4 people out to lunch once a month. I do like to stay in touch. It's a pretty narrow filter.
Anything to add, or can we open it up to some audience Q&A?
Yeah, well, the whole thing that Ben was talking about earlier with the game theory things, I think that is a really common thing these days. And I think there's a really fine line between information asymmetry, which is actually really important when you're raising your round, when you're negotiating with investors early on, for the entrepreneur at least, and then transparency in terms of actually telling the truth. And that's incredibly important, because if I am negotiating with an entrepreneur and I find out that they've basically told a white lie, or they're in a gray area in terms of the truth, it's over. I'm not gonna, you can't trust them anymore. And so in terms of building momentum, so I just led the first seed round that I've ever led before. Recently, it was a company called Kiwi AI out of YC, and it was a really sort of a fun experience. And so I'd fundraised before, and obviously participated in a lot of the rounds, but I never led one. So it's interesting because a lot of investors have the mentality, especially at the seed stage, when there isn't one person coming in and just writing the whole check or a huge part of the check, that, well, who else is involved, who else is in, sure. They don't want to get in yet until other people are in. So it's this game of cat and mouse that the entrepreneur has to play. And so that's kind of where the whole, oh, we're oversubscribed, but really there's no one in the round yet. That's where that comes from, because there's a problem of sort of starting the flame at the beginning. So I like to jump. I try to, when I find a company that I really like, I like to jump in and write the biggest check that I feel is appropriate for, and try to start it for them.
Awesome.
And that's sort of what I did with this startup, and then start making phone calls, and I think within a week and a half or something, they had hit their $1 million raise, and then now they're at like 1.6 million. And it's like they have to turn investors down.
Nice position to be in.
Can I respond to Ben's comment really quick, though?
Which
Okay.
one?
Yes,
In regards
time
to,
is
like,
up, but
the-
yes.
I'll be really fast. So I think it illustrates that every single VC is different.
Right,
And they have very different motivations. And I'm going to say a slightly, probably dirty world in the generalist VC world, which is impact. Like, as an education investor, I care about education, people getting access to education at scale. And so there are a lot of different companies out there that might not fit our portfolio, but I think could create value within this space. And I'm happy to take meetings with that entrepreneur and spend time and think about how they can help create their, how they can actually scale their product to create meaningful impact within the education ecosystem, and potentially recommend them to another education technology VC who might have a slightly different focus and a different strategy when it comes to investing. And so, whereas, yes, I agree, everyone wants to be creating that relationship with the entrepreneur ahead of time. I actually want to create relationships and help entrepreneurs improve access to high quality education as a whole and help. And so there's an ecosystem aspect that I take to my meetings as well. But I think that just reflects a slightly different focus and a slightly different agenda because of the different types of VCs that exist. And you're trying to find, it's a marriage, precisely as Ben says. And you want to find the right partner.
By the way, just in fairness, I know we're out of time. On the first date we have, you still get the whole date. I'm still buying you dinner. So I also want to, my attitude is, you're dedicating your life to being an entrepreneur. I have great respect for that. In 10 years of doing this, I've met 2 assholes. That's stunning.
That's a low
1,000
ratio.
pitches a year, and I've met 2 assholes that I don't want to be involved with. So I do try to do the same thing. However, I want to do it in that hour. So if I've got somebody that's a good fit for you, the thing I do now is, wait, how about Bob? Okay? And I do the intro right then. So in fairness, if I do end up sitting with you and I do offer something, I'm going to do it in the meeting. And after that, the second hour is about 10 times harder to get. But if I can get you to people while I'm spending time with you, I always want to give value, whether that's through an insight that I learned or anything else or a connection I can make.
Okay, I have to rein this in. Do we have 1 or 2 audience Q&A? Nima, do they have a microphone? Or?
Yep.
Yes, sir, right in front.
I have a question regarding you hunting for startups to fund them, right? What if I am a startup that doesn't need funding, but I am ready to sell licenses to startups that need to be funded? So can you act as a liaison among our startup and new startups that need money to implement our technology and build power stations?
So you want to use investors as a sales channel? Is that what you're saying?
Something like that. Not just sales channels, just people who will help new startups to buy our licenses and build fantastic power plants.
Do you guys have
I'll answer that really quickly because I've been on the side trying to sell through investors previously as a consultant and now as a software, selling fundraising software. It doesn't work. You can't sell through VCs. They're just, taking too many meetings with entrepreneurs. I've tried that for 10 years. And so
The
I
only
wouldn't waste
caveat
the
would
time.
be if you're in a meeting with somebody anyway and they have a portfolio company you're a fit for and you can just say, hey, can you make that introduction? But it goes back to if it's in the hour, great. Sure, Bob would really love this. Let me connect you guys. After that, tough.
Do we have time for one more?
One more.
Oh, let's see. Back there, please.
Hi. Thank you so much for your time. Very helpful insights. I just had a question about the food industry. What do you guys' emotions around food and the number of food startups that have come where other VC were thinking right now?
So I think it's an incredible industry. I think I'm also 95% vegan. I think that currently there's a huge problem with the sustainability of the way that we currently consume food. And there's a revolution that's happening that will continue to happen for the next 10 years at least in terms of using plant-based proteins to and bioengineering, everything from genetic engineering of crops to robotics to automate sort of the entire process on the farm side. and also the sort of molecular and bioengineering that's happening to produce new types of food. And I'm actually really interested in that space. So if you have like a really cool startup, then I'm interested in talking to you about that.
Do you want to give your email out, or
I just
Come back to that.
track him down? You're a hustler. You're a founder. You're a hustler. You can figure out how to reach his email. It's not too hard.
or just
Any other thoughts on food, or should we wrap it up?
Go ahead, Rick.
I mean, I'm a freelance food and wine writer as well. I've written for a bunch of print publications, and I do restaurant reviews. So when you do your research on people and you see something like that, it's a double-edged sword. I actually have a hard time believing there are meaningful venture scale opportunities in food or wine. Now, more recently, there have been a lot of variations on the theme, everything from delivery to Soylent, which is, to me, a rehashed version of something that happened when my father was trying to lose weight and bought a bottle of liquid protein that he chugged down every day because it gave him the minimum nutrients. Didn't work then. I don't see why it'll work now, and it doesn't seem like it's good for sustainable human endeavor. I'm 95% omnivore, and then I'm 5% vegan. But here's sort of the ultimate answer to you, or actually to anybody. So a couple people asked me over the last couple of weeks, what am I excited about right now? And I thought about it a lot, and other than my own startups that I am extremely excited about, nothing. Like, nobody has walked in with something that's made me say wow in a long time. And I have a very simple belief about entrepreneurship. I don't know what's coming. You do. And one of you, perhaps, has something that when you come in and say, this is what you're going to do, I just say, wow. And that is my quest every single day, is to find someone that gets me to say, wow. And if that wow is in food, then I'd be surprised, but who knows? That's what I'm here for, is to get surprised. In fairness, because I'm the guy that has to take off immediately, I am Ben at canvas.vc. Since I normally stay around and hear all the pitches, but I have a board meeting I can't skip. If you want to tell me what you're doing in one line, I am more than happy to read it. Didn't say respond.
okay. Well, so I'm Eric, E-R-I-C-K.
All right, there we go.
At hyperspeed.com. So yeah.
Jennifer?
Jennifer at learncapital.com.
Okay, all right.
There you go. You get
Good job.
ultimate
All right,
spam
let's
alert.
have a round of applause for these guys. Okay, that's it. That's a wrap.
Thank you, guys. A couple announcements. So just to prove to you that sometimes random things happen, we had a sponsor who was offering a prize of $25,000 in development services. A company's called DevPro. They have a team of over 200 developers. Jeff is the founder and CEO. And they picked PhotoBloom. And actually, PhotoBloom was one of my favorites as well, because I think there's a lot of things you can do with that. Jeff, come on down. They have a big check for PhotoBloom. Justin, come on.
So is there a photographer here? Can you
Yeah.
take a picture?
Awesome. So it's lunch. A couple things. If you go to the Radivate booth, they're premiering their episode 3 of their show called Driven. So check that out, and come on back at 1:50 or something, 1:55 for the rest of the program. Enjoy your lunch. Check out some of the exhibitors. Anything cool? I hope so. All right, next panel. So originally we wanted to do a panel on machine learning and a panel on AI and a panel on autonomous. That didn't work out, so we just combined it. Anyway, Chris Farmer is the founder of SignalFire. It's almost like a fund incubator, I guess, structure. Cheetah is working on EcoBots, which is using AI to invest, which I thought was really interesting. Zume Pizza, I don't know if you've had it, but it's awesome, it's fast, and it's healthy. Really enjoyed that. I had it for the first time at launch. And then Felipe, it's kind of random. I was in Berkeley getting a cinnamon roll, and all of a sudden this little machine goes past me, and then I follow it, and basically it was this little Kiwi delivery, Kiwi campus, which delivers food on campuses. So, I want to welcome everybody. Come on down, Felipe.
Hello, everyone. Hello, everyone. It's great to see you all. Today, we're going to talk a little bit about various uses of AI and how a few of these companies are using it. I'm Chris Farmer, founder and CEO of SignalFire, which is a venture firm built on top of a real-time platform. We track more data on startups than anyone in the world and use that as competitive advantage, both in investing but also in supporting our portfolios. So we're sort of one of the first sort of tech-enabled or AI-driven venture funds. With me is Alex Garden.
Hey, hi, I'm Alex Garden, CEO, co-CEO, and co-founder of Zume Pizza. I'd like to think we make the best delivery pizza in the country. It's delivered on average about 20 minutes after you order it. Same price or less as Domino's, half the calories, half the cholesterol, half the fat, and we do it all with robots and AI and trucks and about 3,000 other complicated things we didn't want to invent, but we had to.
All right, and Cheetah.
Yeah, hi, I'm Cheetah, co-founder and CEO of EcuBot. EcuBot stands for Equity Robot. It's not a chatbot. What we do is we parse almost every public companies out there, their financial data, and all the relevant news articles, like millions of articles every day. We combine them together so that we can give very sophisticated tools for financial advisors. Like financial advisors, they can't deal with so much of information out there, so we are trying to make their life easier. We are also enabling an ETF, which will be running on AI in New York Stock Exchange pretty soon.
All right, and Felipe.
Yeah, hello everyone. My name is Felipe. I'm the co-founder and CEO of Kiwi, and we basically make real robots for food delivery.
That's great. And so AI is one of the biggest buzzwords in the Valley. It seems like every company is tagging it onto their name the way the .com was prevalent in the late 90s. You know, when you guys look at your respective businesses, where do you think AI, robotics, and the related areas, machine learning, are going to have a huge impact, and where do you think are the limitations?
Yeah, I can go. The way I see AI is a muscle power. It's a tool. It's not going to run over the world. Like, it's not going to replace all of us pretty soon. Wherever things that we need, we can apply cognitive rules. We can apply AI. So like, if somebody, we don't care, for example, we don't care who delivers the pizza, AI can deliver the pizza. But if we think somebody individuality, I don't think that would be hard. So it will be a tool in many different ways, healthcare, everywhere. I think we'll be seeing AI. I think the fascinating thing about it is at some point of time, we won't even realize the AI is driving many things. It is part of our life. But at the same time, it's not going to, that's my opinion, it's not going to replace all of us.
Okay. Felipe?
In our case, we believe that AI is the way to improve and make us more efficient. Right now, like AI and robotics and this stuff, it's what it's trying to make is to lower the costs in a lot of things and also make them more efficient and faster. And in the coming years, it's going to be good for the society to have this kind of technologies.
Now, I know you guys are a little bit different than AI, more focused on the robotics side of things, but how do you think about the impact of how you've reinvented your company?
Yeah, one of the areas that we invested a lot of time and energy into was understanding the role of automation broadly in our business. So for us, that means a lot of different things. It means AI, machine learning, robotics, general purpose automation. And the reason we do these things, it has to be in service of something. We do it because it allows us to significantly lower our labor expense relative to the rest of the restaurant industry. And the reason we do that, we take a huge part of that captured surplus and we reinvest it into much, much higher quality food, but we have much better margins. And the people that we do employ all make a great living. They make a minimum of $15 an hour. In many cases, they make more than that. The average is $16.31. They have full medical, dental, vision benefits for them and their families, fully subsidized, no copay, and they're all shareholders. And if you're someone, I'm thinking of one person in particular, chosen at random, who has been making pizza for 14 years. The gentleman is very, very smart, very talented guy. His life circumstances didn't give him the break that he was looking for, and getting a job working at Zume, making pizza, has changed the trajectory, the fortunes of his entire family. And so in our case, we've applied general automation, which includes several layers of AI, to producing a better, healthier product for consumers, creating a better life for our employees, and doing all of that with great margins, which is good for our investors. And I think that's the balance that you were talking about, one that I believe a lot in, which is, we're about to see this coming wave where automation and AI is going to broadly affect every business. Every CEO is going to have to make decisions about it. And conventional wisdom over the last 100 years says you take all the captured surplus income and return it to shareholders, but that's about to change. There's a social consequence we're all going to have to wrestle with as it relates to automation, and specifically as it relates to AI. And that's the really interesting conversation to me, is like, what are we going to do as CEOs with it?
So how do you guys think about that? I mean, both of your industries, financial services and transportation logistics, employ huge numbers of people. How do you see their roles evolving over time, and how do you think about the transition as you start to bring AI into more of the sort of workflow and processes that normally would have been done by humans?
Well, it's important to say that like AI automation, it's happening, but it's still too early. Yeah, it's maybe, for example, in our case, to replace or to have like replace couriers, it's going to take maybe between 5 or 10 years. But the important thing that I want to mention is that, for example, we just work in UC Berkeley, and for example, for a student, it's really difficult to get food on demand because it's expensive. Like, they have to pay the delivery fee, the service fee, plus tips, so they have to pay like $9. And the students are broke, so they can't afford that. So with our approach, like what we are trying to do is to offer this kind of services that exist now to more people. And in that transition, I think that maybe people, like there is the universal basic income, that I still say that it's too early to discuss that, but those approaches are very interesting. Like if cost of living it's actually cheaper, you can do like whatever you want. If you don't want to be a courier, you maybe just want to have your life in music or art. That could happen.
I get a sense you disagree.
Yeah.
I don't believe in universal basic income.
Okay.
I believe in the fundamentals of economics. I think the fundamentals of economics is like, it's kind of evolution. Like, we have to compete with each other. I think competition brings enrichment to our life. So AI is changing the cost structure. How is cost structure in your business, cost structure in pizza delivery business, and it's making our life easier. So think about it like the way, if you see from agricultural economy to industrial economy to information age and the AI age, we can say, it is changing the structure of the society. It doesn't mean that people are sitting idle. They are still working, but in a different kind of ecosystem. So I think that's what is going to happen. The AI is there will be still jobs. You can't really go and replace everything with AI. AI is a tool that augments our life. It's not replace us. Like for financial, like I'm in the finance industry, we are trying to augment what financial advisors are trying to do. Is it going to replace all the financial advisors? No. Is it going to replace all the quantitative hedge fund? I like to, but I don't think it's going to replace the hedge fund guys. It will be still there. The people interaction, the thing that require individuality, I don't think that is going to replace the AI. Universal basic income, I don't think it's going to happen.
But for example, what do you do when, for example, self-driving cars? 20% of the jobs are related with driving a car. And that's going to happen. Yeah, that's something that you can't avoid. What is going to happen with those 20% of people with those jobs? Like,
yeah.
What do you think? Don't you think that?
Can I weigh in on that?
Yeah, of course.
So, obviously, we are constantly being asked by people to talk about, what is the consequence of creating a new model that has fewer people, even if they're better compensated. And, so we've gone back, we've studied the historical consequence of the last big shift, which, as you mentioned, was the Industrial Revolution. And, there's several examples. One I like to use, though, is that there was the mechanical loom was introduced, and the mechanical loom essentially put all the weavers out of business. And so people ran around saying, okay, well, there's your proof that, sorry, you guys are probably always doing the glass-breaking line in here. There's your proof that automation of labor is going to be the end of society and lead to either massive unemployment, dystopian future, or UBI. What actually happened was that the cost of fabric plummeted, and what was previously the domain of only very wealthy people, which was custom clothing, became almost ubiquitous. And there were more jobs created for sewers times 100 than there were jobs previously for weavers. And so what happened actually was the introduction of radical disruptive new technology created more jobs than it destroyed. But there was a valley of uncurated social consequence between the destruction of the first set of jobs and the creation of the next set. So we can talk about UBI, which is a solution for a long-term problem where there's no more work for people to do, but there's a surplus of resources. But what's more likely is that there's a short-term change between the destruction of certain classes of jobs, like, for instance, wealth managers, and the reintroduction, or hedge fund managers, if you get your way, and the reintroduction of a new class of jobs. And this is what I'm talking about. As CEOs, we're going to have to talk about how do we help manage, or how do we help curate that social consequence so that it's accretive for society versus just taking the capture of surplus, returning it to shareholders, letting the government take care of the unemployment problem in the shift, and then it'll all sort itself out in the end. I think we can do better than we did 100 years ago.
Absolutely, yeah. So I totally agree on the point. The opportunities, so same as evolution, there is an evolution of opportunity happens. Opportunity moves from one place to another place. And for all those entrepreneurs out there, I think that's something that you should be more aware of it, is that when you look at it, opportunities, even if it is there, you have to create it, right? I think that you can see the gaps, that they're always the moving gap. You can find those areas, and it changes based on what is happening. And the AI is going to introduce those kind of things. They're going to create a new kind of gap.
The nature of work is going to change.
The nature of work is going to change. So it will be interesting. That's what I hope.
And so all three of you work in regulated industries, right? And in the case particularly of transportation, like lots of labor unions and whatnot. How do you see you mentioned 5 to 10 years for some of these things to be adopted. I look at this as multiple layers of sort of things that have to happen. One is the technology element of it. It's like there's a social element, there's a regulatory element, there's retraining and various elements that you'll need to ultimately make that transition, plus the sort of obsolescence of existing equipment that's out there or systems. How do you guys think about hedging against what is sort of unclear timing, given that there are some non-technology inputs into when some of these technologies can really be full-blown to their technical capabilities?
Again, coming back to the same way to think about it is wherever there is a need of individuality, I think that will be there. So the regulatory things, the regulatory aspects of it, like both in finance sector and the transportation sectors. So think about in the transportation sectors, there will be, it will be replacing, I think first in the trucking industry, it will be a huge demand. It can replace those things. But at the same time, we cannot take away the regulatory aspects of it. So that is where people who think about it, who makes those rules or how we look at it, the issues, how the liabilities get accumulated. I think that we will have some individuals looking at it, and I think those kind of jobs will be there. I think probably there will be more kind of those jobs. I'll be expecting in the trucking industry probably more people looking at it and making sure that we don't get into the landmine of those lot of lawsuits, right? An accident and all. Like, I think that's gonna. So anywhere there is a requirement of individuality. Like for an example, we have to be careful about AI. Like we are creating a lot of chatbots. I don't expect a hotline for suicide, for instance, right? That won't be run by the AI forever. So wherever there is need for somebody, a compassion, for an example, so those kind of things, we will be there, will be prevalent in future, more of it. So anywhere there is a requirement individuality, I think those kind of jobs are going to grow. That's what I think I'll hedge against.
I try not to get drawn into the debate about how effective AI will be one day, because the truth is we don't know.
Yes, absolutely not.
And as a result, we can't really know how it's going to affect the future of work. But I think we can all agree that technology continues to improve, and people will find new applications for it. So rather than getting drawn into like the future state, what I prefer to focus on is what's available today that's practical, what's available in the next 12 months that's worth me investing in, and how do we apply those things in ways that directly impact either customers or our employees' well-being and work satisfaction. One example, and this is a silly thing, but that a lot of people would take for granted, but it's super practical. So we have this robot named Bruno, and Bruno picks pizzas up off the end of our line and puts them in the oven. And you would think, holy smokes, you guys built a $150,000 work cell to pick up a pizza and put it down again. And there's vision, and there's actually a whole bunch of interesting ladder logic that's hooked up to an adaptive learning algorithm. And you think, okay, why on earth would you do that to replace a spatula and a person? Well, it turns out the line is a food-safe variable speed line that spits off a pizza every 22 seconds. And the oven is an 800-degree baking oven that has pizza stones in it and all this other innovation. If you watch a person do that job for 8 hours, not only is it unbelievably unsatisfying and mind-numbing, but it's actually quite dangerous, because that 800-degree oven, the odds that you will burn yourself in an 8-hour shift are 100%. And some of those burns can be quite bad. So we've completely eliminated that problem, and we no longer have a person doing that work. Now, it turns out it's like a Rube Goldberg device to move a pizza. It's ridiculous, and now we've got it worked out. It's easier. But that's an area where we were able to take today's technology and apply it to something which on the surface doesn't seem like it's a big problem, but actually was a whole game changer. And for what it's worth, that work cell pays itself off in about 9 months, and after that, it's pure gravy.
Yeah. And how about you on the last mile?
Well, answering your question, I believe that, for example, in our case, that there are already two states that passed law in like robots, food delivery with robots in the sidewalks. That was pretty impressive. Like, it was very impressive that was too fast. But still, I think that it's still, we still need to experiment more in that part, in that field. And in terms of AI, I think that, of course, it's still too early. We all agreed on that. But according to the potential that I saw on AI, I think that it should be regulated. Yeah, I agree on that. It should be regulated. And in the valley between, meanwhile, like the companies, we kind of like continue experiment with our products. And for example, we are doing in a campus because it's easier to experiment there. Yeah.
Got it. And how do you deal with like the last 10 feet? Right? If there's a door or a gate or a dog or,
That's important because, for example, our robot is not totally fully automated. And I think that other companies that are making robots like for food delivery, it's not totally fully automated. And for example, we always use a human. And for example, these states, Virginia, in the law, they said that each robot has to be remotely, under surveillance remotely, always. So, for example, with the last 1 minute, actually we have the last 1 minute, we made it always with a human taking control of the robot. So we can make sure that the experience is good and that we are actually in the correct address. Of course, there are a lot of fields and technology that we can apply to be sure that we are in front of the door. But semi-automation, it's going to be a trend that I think, in my opinion, will be very interesting. I assume that also with Zume Pizza, it's semi-automated, that you still have a lot of humans involved in the process.
But let's say there's an apartment complex. How does it navigate stairs or elevators or those types of things?
Still too early. It's not possible yet.
I can talk a little bit about that because we have that problem too. It's actually an economic trade-off. So you can provide, there's always a way at a cost to provide a high-quality service where the food is delivered directly to the person regardless of where they are. And we have that problem of homes behind gates or apartment complexes or elevators, but we also have the problem of parks. People order a Zume Pizza to the middle of a park all the time, which has its own unique challenges. What we do is we use a combination of economic incentives and customer education. So we'll say, look, if you're in the middle of a park and you want your pizza delivered there, or if you want it delivered right to your door in an apartment building, there's probably a delivery service surcharge. And if you want to come to the curb and pick it up, there's an economic incentive to do that. And we're not doing it to disadvantage the customer. We're just saying, look, you can have anything you want, but we have to do it in a way that is economically sensible.
Got it. And in financial services, how do you ensure that it's not another long-term capital management? What are the human checks and balances on algorithms and the sort of black box?
Yeah, actually, you pretty much said that. So there has to be a human check. So even though we are providing a lot of consolidated informations, at the end of it, be it the automated fund you are managing, or be it the tools that we provide, there is eventually a person who is looking at it and making sure that it is not screwing up, like doing something stupid. Because at this stage, we cannot let it go free. We are not there. I don't think, I'm not sure whether we'll be there or not. Mm-hmm. And specifically when there's a significant amount of risk involved, we have to put a person looking at it. But what it does is that we give him the muscle power, right? He's not alone. Like he's empowered with a lot of data to make sure he make a more sensible decision based on that.
Are there any questions out in the audience for the speakers?
There is a question over there.
It's hard to see hands. So the question, if I understood, the question, if I understood correctly, was around, with the displacement of jobs, is there going to be a tax on robots?
Yeah. So I think first it's important to get grounded on what were the overarching sociological norms at the time. So around the turn of the century, we hadn't really delved into what we broadly call socialism today. The idea that either governments or institutions have a moral obligation towards the people that they're responsible for. If you think about it, labor was seen very much as a mechanical asset, and it wasn't really until the 30s and the 40s that we start to see some of those concepts take hold. So first of all, the sociological climate we're doing business in today is very different than it was then, so it helps to understand it, but you can't do a direct comparison. Second thing is, I'm not convinced, I'm open to the conversation, but I'm not convinced that government needs to provide the legislation that fills the cave, as you called it. Because, and I don't mean this to sound disparaging, but I think the pace that government moves at will not be sufficient to fill that cave. I think what's going to happen is we're seeing a nonlinear increase in the capabilities of AI, and frankly, a nonlinear increase of the cost effectiveness of general purpose automation. And Frank, if you think about it, the Treasury Secretary just said that automation displacing labor isn't something that's on their radar for the next 50 to 100 years, which is like a mind-blowing statement if you think about it, right, from where we sit. So I think what's important is that leaders of companies need to fill the role that would historically have been filled by government due to the rate of change. And I'm just going to close with one more thought on that. Many people would argue, well, why would leaders do that? Why not just make your bonus by crushing your numbers for the quarter by bringing in the automation? And so here's something to think about provocatively. The CEO of Wendy's just went on the record publicly touting as a win the fact that Wendy's is rolling out self-serving order kiosks in their front of house in 1,000 restaurants nationwide. So you would say, okay. And he was so excited this is going to let them dramatically reduce labor in the restaurants, and just going on and on about this. But here's the problem. What percentage of Wendy's customers are currently employed in jobs that stand to be displaced by the automation of labor in the next 10 years? 61% drop in retail in the US last year. So we're seeing the bottom fall out of some of these markets. So if you want to be a CEO who's going on record talking about how awesome it is that you get to cut jobs because of automation, expect picket lines outside your office pretty soon. So I think there's both a moral obligation as well as a self-reinforcing economic condition that's going to force companies to take the lead in this change. That's my opinion. Thanks for the long answer.
I can just briefly add that. So what AI is bringing is moving so the taxation is about fairness and equity. That's how I view it. So the AI is shifting some of those economics from one set of people to another set of individuals. So if you still apply the fairness and equity, I think it's good that we are having that discussion. So yeah, I think government need to catch up pretty soon. Otherwise, we will be seeing a void over there. But at the same time, are you going to tax each and every robot? Probably, I don't know, think so. But the whole mechanism is going to play in together, say that, okay, hey, these guys are capturing the higher value. That means the taxation is going to happen over there. So.
All right, I think our time is up, but thank you all.
No, we have
two more minutes. Okay. Great. And so, in the transportation sector, which is obviously, even stronger from a, union and labor perspective, I mean, how do you see trucking and some of these sectors where there'll be large gainers in some parts of the country and parts of the country that lose dramatically economically as a result of this?
As I said before, to have these robots working, we will need a lot of human power. Yes, and so we still need a lot of people to help us have this working. And one reason that I have to say that is that if we can offer better prices and better service and a better product, more people are going to can afford to have that. And I think that the transition it's going to be enough, like that valley that you said before. If we have semi-automation, that could work.
All right. Well, I think all of us are probably going to take the under on the 50 to 100 year projection on when this is all going to happen. But it'll be exciting to watch as each of you roll out your businesses and how far you can take the technology in the coming years.
Thank you very much.
Thanks a lot. Thanks.
The sky's the limit as far as performance.
I just wanted to meet David. I'm a fan of the classical. Yeah, great product. Absolutely. Love it. Yeah.
I forgot I had to come back up here. Could you do something to the sound? My sound? Louder? Okay, you heard that? Louder for the speakers.
Okay, you probably.
All right, while I do a little housekeeping here, our next speaker is the co-founder of Kabam, and Holly is awesome, and I don't know if you've played any of the Kabam games, but they were also just acquired a couple months ago. So Holly's going to come talk about that journey. Holly, come on down.
Sure.
All right, welcome.
Hi, thank you. Thank you. Hi, everyone. Welcome. Thank you all for being here, and thank you for that wonderful introduction. So I think I have some slides. So today I wanted to talk and share with all of you about failure. I know many of you who are either starting your journey or been on your startup journey, you've probably already had a ton of failure. Well, for us in our Kabam story, it's been littered with a bunch of failure over 10 years. And if I had to tell you all of our failures, I don't know how long we'd be here. So I had the great luxury of trying to pick which ones I would talk about. And so in order to inspire and encourage you, I decided to choose the ones that were major failures that turned into successes, so that if anybody can learn from our mistakes in our 10-year journey, I'm more than happy to share. So first, just a little bit more about our company, because I don't know if a lot of people know about us. We've been headquartered in San Francisco. At the height of our company, we were about over 1,000 employees in 6 offices worldwide. 4 of them were what we call development centers or studios that built games. Not a lot of people know, but we started the company in 2006. So it's been around for a while, but we started making games around 2009. There we go. So we've partnered a lot with Hollywood. We've made games for Marvel, Hobbit, Avatar, Transformers, you name it. We've probably either talked with them or have worked with them. And then our investors have been pretty amazing. We've raised over probably $245 million in our 10-year journey, and we just sold our company a couple months ago for over $800 million to a company called Netmarble. It's a South Korean gaming company. Thank you. Thanks for the woo. We're pretty happy. Thank you. These are what some of our games look like today. We like to say that we're AAA console quality right in your pocket. And we pretty much have been mainly working with Hollywood. And happy to talk about that afterwards in terms of why we turned closer to brands. But our journey didn't always look successful. It actually started out with several failures. Our first failure, what people don't know, is we started with a corporate social network. That's how we raised money. I know, I think you even read those words and you're thinking, how did you not know it was gonna be a failure? It was a failure. The co-founding team, with the 4 of us, started out together. We'd meet in coffee shops as well as we were incubated in Canaan Partners. They were our first investor who took a risk on us and said, you know what, why don't you go ahead and work here and we'll also give you capital. Just to remind you, the year was 2006. We were people that were kind of influenced by what was happening in the Valley. So the .com crash had happened, but there was this kind of little bit of inkling of hope. There was a term called Web 2.0 that came out. Meebo had just come out, and there was this new framework called Ajax, and that was the thing that was just gonna change the whole internet. And then there was this company called YouTube that sold for over $1 billion. And I think that that was really an inspiration to really bring back a lot of all these amazing companies that you see today and really push the current companies that we're building, such as like Facebook and LinkedIn. Well, for us, during that time, we didn't have any accelerators, no incubators. YC had probably started on the East Coast, but certainly hadn't heard of us and we hadn't heard of them. So we did the traditional route of pounding up and down Sand Hill Road, and we spent some time talking about this corporate social network. So basically we were like, hey guys, it's just like Facebook, but it's gonna be geared towards people who have money. Because we reasoned, hey, college students don't have money. And we spent a couple years at work and we were pretty frustrated with our jobs. So we left and we said, hey, maybe we can do something like this. Well, we found out pretty quickly that we could not do this. So we launched our site, Company Loop. I'm sure you've never heard of this. This is one of the lowest, this is the only thing I could see on the internet that I could find of it. We didn't keep any files of it. That's how bad of a failure it was. And it's like a very low resolution. So that's why now it's probably super blurry up there. But we had tried everything. It took us very quickly to build, about a month. And then we spent about the next 5 months on what we call marketing or growth hack tactics, which was really spamming your friends and family and begging them to please, please, please use the product. And then when that didn't work, we would cold email some people who worked in big companies, as well as we eventually started asking one of our sales friends to come in and train us on how to do cold calls. Eventually, after all of this hard work, we got 1,400 users after 5 months of hard work and 3 product iterations. So we learned very, very quickly that there just was, obviously, this just wasn't going to be a viable business. So we were a little bit at a turning point in terms of a crossroads for us. And one of the things we learned very quickly was that in starting up, no one starts out as competent, and it's the market that decides competence. So if you think about it, the 4 of us were not very competent at all. We grew a company to over 1,000 employees, yet none of us had managed before. We started a company when none of us were founders. And honestly, we never built a product together before. We built products separately in pieces of it. So it was like piecing together an elephant and not really have seen the whole elephant before. And this is what's so fascinating and what's so exciting about building a business that makes impact and value is that you can bring your PhD, you can bring everything that you have to the table, but ultimately the market is going to decide competence. And for us, they said, you guys are incredibly incompetent, especially with Company Loop, and I would probably say so myself. So we had a couple months left of runway, and we were thinking, you know, what are we gonna do with this? We talked to one of our board members to let her know an update on what was going on. At that time, Facebook had come out with a developer platform. And our product manager said, you know what, maybe we should take a look at this. And I remember talking to the CEO after he came back from the board meeting, which is really him and the other investor at the time. And basically I was like, so what did she say about our strategy of moving off of this and moving into this unknown of Facebook? And he basically said, she said, you know what, you should go where the users are at. We're like, oh, that totally makes sense. After 5 months, we only had a little bit of like, a little over 1,000 users, and we were not getting anywhere. And so that was the thing that, that was the thing that we had learned, that we weren't getting anywhere. The one thing that we did have a lot of issues around was that even though your company, you as a company need to build a business and an organization, the business needs to come first. So for us, when we were talking about all the acquisition and all the users, we couldn't even convert users to customers because we're having so many problems at the acquisition point. Like, we only had over 1,000 users, and we couldn't pull them into the funnel to acquire them, then to engage them, to retain them, and ultimately, hopefully, they would become customers. So from that day after the board meeting, this was something really fundamental that we learned, is that if we couldn't make the users come to you, we should go where the users are. And that was something for us that was incredibly fundamental because it really permeated into our culture. You see, Kabam is and has been a very market-driven culture, and I think it's really because of this first failure, that we knew it was so hard to get people to come to us that maybe we should look at growing platforms. And you'll see this theme for us and how it's proven for us over time. So what we did is we put everything that we got into this new Facebook platform. But when we did, one of the decisions we had to make was we could just take this dying product, Company Loop, and just stick it onto Facebook. But instead, we said, you know what? If it's not working over here, do we really think it's going to work on Facebook? One of the things that we were really struck by that we learned, we said, look, what is it that people want? Like, are people going to be sitting there? Do people go home at night and Google about work? And we're like, you know, we don't really do that. Do other people really do that? What is your core competencies as a team? So all of us were actually consumer-based background. And here we were making cold calls. We didn't really know how to set up a sales team. So we're like, you know what? Maybe this isn't really for us. And finally, the third thing we looked at was our passion points. What are the things that we were Googling at night and we were really passionate about? And it turns out what we spent most of our time on is watching TV, because you do that a lot, and watching sports. You do that a lot when you're happy or sad. So we ended up building fan communities on TV shows and sports teams on Facebook. So this was a long, long time ago, around 2007, 2008. So if you liked Arrested Development as a TV show, you could download our app and have the quote added to your profile or your favorite character, and then you could connect with other Arrested Development fans. Same thing on the sports page. Well, this amazing success was also our second failure, which was fan communities. So we actually, as I mentioned, we were quite successful. That was our product manager, but we were quite successful in terms of this. Within about a month, within about a weekend, we grew over 1 million users. You could see how excited we were. And then over time, we had grown this fan community to over 60 million registered users. And when ABC wanted to distribute their video on Facebook, they actually didn't call it Facebook, they called us up to distribute their video for us. But at the same time, 2008 was an incredibly special year. The mortgage crisis happened. I think there's many of you who were around when this happened. It was a horrible, horrible time for startups. Outside, the economy was just completely freaking out. Mortgage rates were dropping. In fact, for us, a lot of the funding had dried up. And Sequoia Capital, like one of the most premier VCs in Silicon Valley, sent a deck to their portfolio companies saying, you better get to cash flow positive and RIP good times. And that was just, we saw a lot of our colleagues who were running startups just have a really, really hard time. The ones that were most impacted were ad-based businesses, which just happened to be ours. So the ad-based business was just plummeting, as well as the views on our Facebook platform were just going not in the way that you wanted it to. We had about a $3 million deal with an ad network. They pulled out because they said, you know what, nobody's spending any discretionary spending on this. We've seen our ad go from 80 cents all the way down to 2 cents. And we knew that we were yet faced again with asking ourselves these questions. Which is basically the same 3 questions we asked prior in terms of market. So what was doing really well? Well, we saw there was this little company called Zynga that made a ginormous game called Farmville and loved to send lost cows to their friends and family. And we're like, oh my God, this company is recession-proof. Their business model is completely amazing because they don't rely on ads and they could build a long-term relationship with their customer. The second thing we looked at was our competencies. We're like, well, you know what? We think we can do that. We can build apps on Facebook. In fact, we have almost 100 years of app development for Facebook right here on our team. And finally, our passion points. Well, our CEO is an incredibly passionate gamer, but he didn't like the Farmville type games. He liked the games that were much more mid-core and strategy-based. So that led us into building games, which also has one of our major failures as well. But I'll start out with our success. This was the MVP of our first game, Kingdoms of Camelot, which was our flagship product. So for those that don't know, this was really one of the first of its kind on Facebook, but strategy-based games tend to be, or empire building games, are basically you kind of work your farm, you build your farm, and then you build enough resources with your wood mill and your ore so that you can build these buildings. And in these buildings, there's a special building called your armory or the barracks, and then you could raise your army once it gets to a certain level, and once you train your troops and have enough people there, then you could go out and go attack people and do alliances. And so it was a very involved game for its time. And we were the first game that allowed people to chat across people who were not friends on Facebook. I think the chat room was really incredible, as well as having real coordinates on a map to map to where you are in location. And that played a lot in strategy, and it just pushed the strategy so much deeper. So it wasn't just a gifting app, it was much deeper than that. And it was one of the first of its kind. I remember when we invited, we were running a little bit low on cash, so we said, hey, let's invite our friends and family. First, they'll probably ingratiate themselves to us. Second, they'll probably hold back punches and be really nice. It was the worst user testing I'd ever gone through. I told my CEO afterwards, I said, I'd rather have been waiting in line at the DMV than to sit there and watch this. You think your friends and family hold back punches, but they did not. They were confused, they were really upset, they kept complaining about something as small as the artwork, and we're like, oh my gosh, this just is not going to work out. But reality is we you know what, this was the direction we were going in. We fixed what we could, and we said, you know what, it doesn't make sense to change now. Let's see. And we launched it. And it was amazingly successful for us. So we grew over time, but what we knew what was successful was that we were directly monetizing our users. In other words, we were able to see and give value directly to our users without trying to keep on building up all of these page views. And what was so exciting for me is finally I was able to co-create a game. I was also able to create content within the game. I didn't have to wait for a team to win or heroes to come back with a better script. I can just keep on going. So I remember in Thanksgiving time when we knew it was going to be a hit was we were watching just the admin board go, and I think we got about $7,000, and we had never seen anything like that from within a day from our ads. We just are used to seeing 2 cents, 3 cents, and multiplication of multiplication. But our greatest success also led to some of our failures. Facebook came along. Well, we were on Facebook, but they came along and they enacted a 30% tax. So for those who weren't there at the beginning, a lot of people, they always promised developers that there would not be a 30% tax. But as you know, their platform was getting bigger, it totally makes sense that they would want to tax it. Unfortunately for us, we had set our business model a certain way and our spending a certain way so that the 30% tax, no matter how we sliced it, would have a very unhappy outcome. So it wasn't a very happy situation. And how we were able to figure out that this 30% tax would impact us very gravely was a little bit about this model. And this is a model that I think if you are doing a business where you directly ask money from your direct customers, this is something that I think you should try to figure out as soon as possible and always be learning about this, which is know your LTV, which is your lifetime value. For us, we knew it up to a certain point. We knew what the payback period was. And then also know your cost of customer acquisition, like how much does it cost? And always keep your cost of customer acquisition below your lifetime value. So our biggest weakness was actually our biggest strength through this whole thing. We were not a viral app. I could not for the life of me get my mother and my sister to play my game, mainly because it just didn't have viral things to it. It really appealed to a mid-core audience. And I was always so jealous of the Candy Crushes, of Farmvilles, because everybody just knew about them. And it was so easy for people to pick up. But the thing that they have within their games that we didn't, that started working towards our advantage, was that they were able to use the K factor or the virality factor. So when I send an invite to somebody and it sends to 10 more, then that invite behaves like a great multiplier. But the problem with that factor, that K factor that does virality, is really there is very much an assumption that's based in there. So for us, we were able to quickly find that out. And so we moved very quickly onto mobile games. And we're the only Facebook company, gaming company, that was successfully able to move on to mobile games. And we became the top grossing app of 2012. So that really beat out the Angry Birds, Facebook, Pandora, and it really ushered in a whole new wave of in-app purchased games and other types of apps as a result. So just remember that your largest success can become your largest failure. And I know that sounds sad. But on the flip side, you can certainly remember that your largest failure can also become your largest success. But if you take everything that you learn and put it into everything forward, I'll hope to see all of you on your next 10-year overnight success. Thank you.
Okay. All right, our next panel is about mistakes and what not to do. All 4 of these entrepreneurs, I'm sure, have made a couple. So if you have a company and you want to have your employees expense stuff, so Expensify is an awesome tool. Matt Munson of 2020. Athenaeus, if you need an apartment, Zumper is the easy way to find an apartment. And then, Naomi does Cloud HQ, which is extensions for Google Chrome. And our moderator is Scott Austin. Scott, gang, come on down, please.
Hello, everyone. All right. We are all together here for what will be a group therapy session on startup mistakes. I'm Scott Austin with the Wall Street Journal. Thanks so much for joining us, and welcome panelists. I've been covering startups for more than a decade, and I think founders sometimes want to make it seem like, or at least the appearance, that they're crushing it, that they're killing it. And it is nice sometimes to step back, to open up, to reveal the issues that all founders go through. And your startup is going to be different. But I think it'll be somewhat humbling to hear about some issues, especially in the early days when you're a founder, when things can just go haywire, and to talk through some of these mistakes. So we're going to try to attempt that here in the next 30 minutes. And thanks so much for joining us. I think we'll start with the team, because it's probably the thing that founders really spend the most time on, whether it's financially or just most of your time trying to accommodate your team. So think back to the earlier days. It's probably not that long ago. And when you're talking about hiring, when you're talking about even firing or retaining employees, what was a mistake? What was something that didn't go right? And I'll start with you, Naomi, since you're right next to me here.
Sure. So I think that one of the biggest mistakes I made in the early days was that I wanted to accommodate my employees a lot. And when you're overly accommodating your employees, it's a give and a take. And when you do that, you realize that over time, they're going to keep asking for a lot of accommodation when you have that kind of relationship with your employee. And you kind of want your employees to step up. Mm-hmm. And so that was my biggest mistake. It was my own mistake, not theirs, that I was overly accommodating to them. And now I kind of just want them to be more of an equal or even better than me, really.
And what would you say when you talk about accommodating them? What were some of the things that you might have done that didn't necessarily work out?
So when I was hiring, I would have to train from scratch, and I would overly explain how to do the job, maybe. Whereas I want somebody who can think on their feet a little bit more. So now sometimes I might ask questions like, what would you do in this case? And I want to get that feedback. Mm-hmm. I want somebody who's a go-getter. And sometimes when you're teaching everything from scratch from the beginning, it's good to do that initially. But as time goes on, if you see that the growth is kind of stunted, that's because you're overly accommodating your employees. You have to have them bring their talents and their light to you, into your company.
Right. Now, Optimus, tell me, because I know we talked a little bit about when you were hiring, whether it's you hire for the smarts. You basically hire the people that are the most talented, coming out of universities. The best engineers may not be the best plan. Tell me about your experience.
Yeah, no, at a high level, I think this panel is excellent, because when I went to panels like this, everyone talks about their success as an inevitable narrative, and it isn't. And it's in retrospect, you can make all of this sound brilliant and like you planned it, but it's never really like that. So at Zumper in the seed stage, we hired for IQ originally. We just kind of looked at people's resumes and kind of saw their backgrounds, and we never asked the question of is this person a cultural fit? Will they be with us in kind of 3, 4, 5 years time? Are they the kind of person who can have the worst week of all time in terms of their numbers and come in on a Monday and kind of be ready to go again? And so I think the lesson we took out of kind of early stage at Zumper was hiring for IQ or kind of ability is table stakes, and that should get you to your final interviews. And then after that, you're hiring for abilities, whether they kind of complement you or whether it's something that kind of you want in your company that you aren't able to bring as the CEO. So I think it's an obvious kind of thing to say now, but in the first year we just took smart people. That isn't, in retrospect, the right idea. Now, smarts get you in the door, but you spend a lot more time understanding kind of the person and the human being that you're bringing on board.
So how would you describe your culture? Because it is very different at different companies. Like,
Yeah, no, totally. So Zume is an apartment search company. A lot of our kind of board metrics are about consumer usage. You know, we have 5 million users a month, but on a month-to-month basis, it's very volatile because a lot of them are organic. So I think resilience. So I think someone who has that intrinsic motivation to kind of have a really shitty month and come back in and be ready to kill it like the next week is, that's really what we look for at our current stage, where we're kind of a Series B stage, where we're kind of in growth mode. We need brains, and we definitely want like kind of humility, but really someone resilient who doesn't need someone to kick their ass to come in on a Monday. They're just like intrinsically motivated to like succeed. They work great in startups where a lot of you will have quite flat organizations where like you open with, you don't want to manage all the time. You have to have that in their personality.
Do you mind if I jump in on that? Because I think you use a couple words that I really like, humility and talent and so forth. And I think that that is a real challenge, because I think to your point, it seems obvious that you should just go with like, the person with the great resume and all sort of stuff. But I think too often companies get trapped in this idea of like, we're going to hire anybody that just brings incremental value.
Yeah.
And if they add to the value of the team, they're going to be good. But if you have a really good team, you can work with anybody, no matter how shitty they are, and make them work, because the rest of your team can compensate.
Yeah.
But once you sort of like, if you have A people, you can work with anyone. But if you start hiring B people, they start getting threatened by each other, and so they only want to work with C people.
Yeah, totally.
So it's like, like A people hire A people, whereas B people hire C people, and it's kind of maintain this high talent density. And so I think the comment I wanted to make on that was that, so yes, there's a huge pool of people that can do the work, and there's a subset of that pool that can do the work and it's actually like really naturally talented. But I think you have to go further and say like, what fraction of them actually have ambition for their own lives that actually they're going to bring this passion, so you can say, get back on a Monday instead going, and not because they care so much about your problem domain, but because they've mapped this job onto their long-term ambition. And I would say the final thing, and the word that I like the most, is humility. And being able to do all those things and still recognize the limits of your knowledge. I think having all of these is really hard. I think what doesn't make the list is experience. The thing that most companies value the most, I think, is actually the least valuable. Like, experience just means you didn't get fired. Everyone gets experienced eventually if you just rack up enough hours. But I'd say the hard thing is getting people who are incredibly valuable despite all these other characteristics, and experience is just kind of a wash.
Well, how do you then, so how do you, when you're interviewing, when you're recruiting, it's easy to look at the credentials, it's easy to look at this person as a star engineer, but how do you qualify something, the humility aspect of it, and do you get to know that person over a series of several months? I mean, it seems like a difficult thing to do.
I think the credential just lies. I mean, like, dude, resumes don't say anything. They're just pointless. We don't even look at resumes. We prefer people not to give them to us, because it's just basically, chest thumping. And it's like, the only thing I ask a candidate is, what do you want to do with the rest of your life, and how can Expensify help? And I want to hear that you're a good answer, because most people are like, what I want to do is eventually become like a CTO or something. It's like, that is not a impressive goal. Or it's like, I was like, what do you want to do on your deathbed, looking back over your life? What is the greatest accomplishment you want to achieve in your life? What is the biggest problem you want to solve? And I want to have an answer to that. And not that you actually have a very clear plan, but at least try, at least have something. But if you have no idea what you want to do with your life, what makes me think that you're going to have a great idea what to do in my company? It's like, your life is way more important than my company to you. And so show me you care about yourself, and then maybe I'm open to believing you care about my company.
Is it different for senior hires? Because one of the challenges, so we run a stock photo company, and early we raised our first venture money, and a couple of the first people we hired were like, all right, we're going to go get a couple senior people from like Shutterstock and Getty, and they're going to bring this industry expertise. So this idea of like not looking at CVs and them not mattering and experience not mattering, which resonates with me a lot, because the people that we've had success with are the ones that have come in young, kind of grown organically inside of our culture. But are there exceptions based on
Senior people are the
experience, or?
worst. Just the worst.
What's that?
I mean, senior people are awful. Because okay, imagine everyone's like, oh, we're going to hire this really awesome guy who's going to come join my startup. It's like, if they're that awesome, why are they joining your shitty startup?
Why are you available?
It's like, clearly, if you're, it's like.
It goes for co-founders too.
Yeah, I mean, it's like, I think you have to have like the really amazing people are those. It's like, that are, you have to catch them so early in their career, because if they're super amazing, they're gone. They're never going to touch them again. They're never going to be hunting for jobs and things like this. And so anyone, like you look at this huge raft of people out there that are sort of prey upon startups. So they look at their resume, which is super thick. It's like 2 years VP of blah, 3 years VP of blah. And it's always coming in just after they raised money and just before they failed or just after they succeeded. Like, these are a huge industry of people who've never created value in their entire lives and never will, but they profit handsomely from it.
And your boards, you know, when you get to the stage when you have a board, they'll push you towards them. You'll have a bad month where the team you kind of grew and mentored just have a bad month, and it will statistically happen. Your board will come in and say, hey, there's this VP.
This guy I know.
They've been at Airbnb for 12 months, and it
will only have to
happen.
give him 5% of the company.
Yeah.
What a steal.
And
it's like, fuck that guy.
And you have to be able to, no, yeah, so you have to push back on your board sometimes to be like, no, like, sometimes you can bring in new talent, but it doesn't have to be the vanity hire who on LinkedIn looks amazing, but doesn't move the needle. You don't see them after 5 and...
Yeah, at Expensify, we hire no senior people, or none of the senior people that we've hired have worked out. Everyone we've hired has been fresh out of college.
I'm not alone.
Yeah, so it's like, everyone we've hired and everyone we've promoted internally has been juniors straight out of college, and they are fucking amazing because they have no idea what's not possible. No one's told them that you can't do that particular thing. And so they're like, oh, I just, that mountain's in the way, let me just move that aside. And it's like, oh, what, you did that thing no one else can do? It's like, yeah, it wasn't that hard.
With respect, does that say something about you as a CEO, though, too? Because you probably want to wire them to fit the way you think.
Sure, I mean, you have to build a company that's built around.
You must hire people that challenge you, too.
Yeah, I mean, but I'm awesome, so that's easy. No, I would say, but mainly it's just about trying to find people who have passion for their lives, align that passion for this moment in their lives around your company, and then try to get out of the way as much as possible, accept that they're going to probably fuck up a bunch, but everyone fucks up a bunch. Make sure that you can sort of survive whatever mistakes they have, and make sure the mistakes are educational. And then, like, everything's super fun along the way.
I'll move to Matt, but so you've hired, I imagine, senior people that just didn't work out.
Yeah.
How long has it been? About 8 years or so?
Yeah, I started the company in 2008, 7.
And for that reason, you've hired people that were hot shots or whoever.
Yeah, and none of them are here anymore.
Okay. Matt, what's been your experience too as these last few years with your company?
I share a lot of this, but I guess something that's a little bit of a different direction as I think back early on. I'm thinking about my relationship with the team. I'm a first-time venture founder, so 4 or 5 years ago I was sitting in an audience like this. I remember listening to Phil from Evernote give some talk and just feeling like, I have no idea what the fuck I'm doing. I'm never going to figure this out. Like, oh, these guys seem so impressive, and so I think from my first 2-3 years building a team, I felt like I had to fake it. Like, I felt like I had to walk in and act in front of the employees, or even my co-founders, like I had it figured out. And it's just not the case at all. I think we all walk around at times feeling like imposters because nobody goes and gets a degree in being a startup founder or a startup CEO or whatever. And the job is being described as basically just being like really over your head with major challenges in front of you all the time. And a whole team of a whole startup team, the job of that team is to stare intense challenges in the face and try to figure them out. So there's at no point do you ever feel like, oh, I got this. Like and as soon as you do, like 30 days later, something changes. So for me, the big shift happened realizing I hit a point where I just couldn't fake it anymore, where we had hit a really tough time as a company. We had gone through layoffs. We were trying to figure out how to re-energize the team and find our footing. And I was just exhausted. And so I felt like I had no option. I was either going to quit and go do something else or figure out a different way of working and being with the team. And so for my own survival, I decided I need to work in a place where I can show up and be myself and like be honest and like cry in a meeting once in a while or like let them know that like I got some shit going on with my ex-wife that's got me stressed out and so I'm not totally present in this meeting or whatever the case may be. But it had the weirdest effect because like one, it became a place where like I go to work now with a dozen people that are some of my closest friends and we talk about real shit. But it also, to my surprise, like it totally changed the team. Like it totally energized the team. All these things that we had thought were problems for a long time, where we had issues with people's like with retention or work ethic or whatever. All of a sudden, the entire team kind of it became a place where other people mimic my behavior. So they would show up, and when they had stuff they didn't understand, they could talk about it. When they had stress at home with their partner, they could talk about it. And all of a sudden, things that were getting in people's way, like those stress points or things that they couldn't figure out in their job, when they start communicating about them, the team pulls together and it's just really magical. So my entire way of being with a team of employees has completely changed.
How many employees do you have now?
We're 12 now.
So that probably works as a startup, at least when you're a small team. When you start scaling, and hopefully you're...
I think it always works. I mean, we've done 12, we've done 55. I mean, we were a 55-person company doing $500,000 in revenue, and we're a 12-person company now doing $3 million in revenue. We've done all of it. Like, so I think it's an excuse. I think this idea that like you can't be authentic, or you can't be real with your team, or you can't build a workplace where people can really be themselves, the kind of place that we all want to work at scale, I think is bullshit. I think it's...
completely agree with that. There's like this sort of, we sort of accept as a truism that like a startup, you start off with these really amazing people and things are fun and energetic and all that, but then you got to grow up and you got to hire some, adults to do this thing for real, and then they hire a bunch of super shitty people, and that's just like and then eventually you go on to do it again. And like it has to be this cycle sort of thing. And then we create these sort of, we celebrate like the serial entrepreneur. I've done like 20 startups, and it's like, you fucked up 20 times?
You know who's not a serial entrepreneur?
Yeah, it's like...
Bezos.
Yeah, exactly. It's like,
Jobs.
dude, just make an amazing company and just make it bigger. It can be awesome. Like, those happen if you make it a point to happen.
And Naomi, do you...
So I want to add to that.
I know you want to add.
So for employees specifically, when you're hiring full-time, I get that. But a lot of times when you are hiring contractors, I prefer the ones with experience. Because they're
Contractors are very different, yeah.
Yeah, it's very different.
Because those are mercenaries.
I'm sorry?
They're mercenaries, yeah.
Yeah, they are. And I want them on my team.
Yeah.
And when they're really good, I'm going to do everything I can to keep them full-time. So yeah, it's different. So for people who are having a hard time hiring and who are using contractors, at that point, you'll probably want somebody who's much more experienced.
And there's a related learning there too. We outsource whatever the hell we can. Like we have a 12-person team in the Philippines that's outsourced most of our marketing efforts. We have a core growth team, but most of our marketing stuff is outsourced. Like, if you can think about a startup, the objective being disproportionate impact with minimal resources, why would you not, right? As soon as you can figure out things that you can take and put over here with people that are specialists in that and mercenaries, and you can A/B test them against another. We have 3 people that do search engine marketing for us, and every month, the firm that doesn't live up, we swap out.
Yes.
Really hard to maintain culture if you're doing that with your internal growth team, but really easy to do it when you can take parts of the business and pull them outside.
Game of Thrones for marketing.
Shame. I want to see the pikes with the heads out front of the previous SEO firms.
How have you, when you're a founder, you're getting tons of advice. And, I guess we're dispensing some advice here, but hopefully it's through these mistakes that were made. When you're in those early days, you have the idea, you think you have the market, but then people are telling you to do this or that, and you're going in 5 different directions. Can you talk about that? There has to be, I think every founder must go through that, when you're second guessing yourself, and you're thinking, maybe I should go this route, and maybe you're just doing too many products. Who wants to take
Yeah, I mean, somewhat you've got to pull back from the noise. Like, like you said, I was in conferences like this 4 years ago, and you definitely first don't want to build a distance between the people on stage or the people advising you and yourselves. Like, there is no distance. Like, we're all in this together, and just because someone goes on stage and tells you it was inevitable for them, kind of like it's not true. So I think that I moved here from the East Coast and obviously from London originally, and I think when I moved here for the first year, it was so intoxicating that you read TechCrunch, you read all the tech blogs, you go to the tech conferences. We launched at TechCrunch Disrupt. Like, we were a tech darling for the first year, and actually all of it is kind of like important, but it's kind of bullshit at the end of the day if you don't retrench and like focus on like the 1 or 2 things that actually matter to your business and go and execute them with your team, whether they're mercenaries or like kind of junior kids you're going to bet on, or you go super senior, that actually none of it matters. And blocking the noise off, whether it's your board member sending you the latest TechCrunch article about a feature your competitor built that in the short term you're just devastated, even though it has no impact on your long-term outcome, you're just devastated because you're so competitive. And then just knowing that, like, pull back, it doesn't matter, like, let them do it. If you focus on your 2 numbers that get you to the next stage, that's all that matters, and what your competitors are doing, even if it's tangentially related to what you're doing, it's irrelevant. So block the noise out. We live in an incredibly noisy place for kind of tech journalism. No offense to the Wall Street Journal, love you guys.
Always read his.
Don't read the Wall Street Journal. I mean, do read the Wall Street Journal.
Buy the subscription, right? Yeah, it's not for anyone. But block it out, and that is a really important skill as a CEO, whether it's your board, whether it's journalists, whether it's your friends reminding you of all your competition, be able to block it out.
And it's not just you, it's the team, right?
Yeah.
So the three jobs of a CEO are to hold the vision, recruit the team, and provide that team resources, which is capital and clarity. So that clarity piece, and this is me giving advice to my early self, but whenever I sit with a pre-product market fit team and they tell me about how they're spending time, it just makes me want to pull my fucking hair out. Like, don't go to conferences and listen to people sitting on panels telling you what to do. Like, if you think about it.
Don't read journalism, don't go to conferences. What are we doing here?
I mean, but really, like, pre-product, there's two stages, right? There's pre-product market fit. Pre-product market fit, all that fucking matters is finding product market fit. Everything else is a means to an end. So you have this idea of what your business is going to be. There's a bunch of risks, things that you might be wrong about. And you need to pick the one or two things that you're going to go de-risk next. And you should have just on your whiteboard, here are the 10 biggest risks of my company, and orient the team around the next biggest one or two risks, right? Until you have product market fit, which is a little squishy. But at product market fit, you have a real problem, a real solution, a way to acquire customers, and a way to make money that builds a sustainable business. And then once you're there, even when you're in growth mode, like we're really focused on scaling right now. We have 1,200 customers, 12 employees, $3 million in revenue. We're early, growing, but we do 2 things a quarter, and that's it.
Yeah.
Like our entire team of 12, even now, 5 years in, with $12 million raised, we do 2 things per quarter. So how many do you think that you should be doing before that? And the answer is very few. And most, I would posit that most startups burn out. People talk about not being able to raise capital or teams falling apart and co-founder issues and all of this stuff. But most people burn out because of time. Like, and really they're just trying to do way too many things with way too few resources. And the one, as a startup, the one thing that you have that the incumbents don't is focus and the ability to move quickly.
And creativity, I want to add to that. You can't lose your creativity. So once you focus on the problem that you have to solve, and you're devoting all of your resources to fix it, don't lose your creativity to fix it too. Because that's also something that as startup entrepreneurs you have, that your incumbents don't.
So I would, as your fellow therapist here, I would love to go for hours on this. We have just a few minutes, but I would like just to go down the line, just briefly tell me about, because everyone goes through this, that moment, that kind of holy shit moment, when maybe you just started panicking. When something was going wrong or haywire. What was it over the last few years? There has to be something minor or even big.
Today or
this week?
In this panel right now. I can to put you on the spot, we can go back this way.
I'm
if you want
happy
to.
to
Okay,
go
for it.
with it. So our team is remote. We all usually work from our own homes and we video conference in with each other. So my low point wasn't really a very low point because we're profitable. But the low point was that I'm a very extroverted person and I didn't see my team as much as I want to in person. So for me, my low point was just I realized, oh, I might be a little lonely because it's like 10 p.m. I just finished work and my team's gone. So that's when I would just go ahead and like go to a concert or go do something that feeds my creativity so I can come back the next day and give it my all again. So that's my low point. I know that there's probably many more low points that other people
Disaster Matt go. No,
we've had so many we're fucked it's over moments that if you go to gettingreal.io, there's a whole blog about all of the dozens of times that our company has almost died and what we've learned from it. But the one maybe most relatable, we were in an incubator. We were 30 days in. Realized that we had no product market fit. We had 60 days till demo day. We had 90 days of cash left. I was going to have a baby 30 days later and was trying to buy a house. Whoa. Wow. And so in 60 days, we pivoted the company, figured out how to get actually our first 20,000 customers after 8 months of like disaster, and raised a little bit of money and stayed alive. But that has happened like 10 or 12 times. So,
Wow. And you're still alive?
So you just need to keep going. Like, you will have so many of these moments, you just need to not quit.
So I'm pretty scared now because I had a board meeting just before this, did this, and then my wife's going into labor in about 24 hours, so I'm in the zone right now. But my lowest, I think my lowest point, and there have been honestly like dozens, and we've raised $40 million. So we've raised a lot of money, and there have been so many low moments on that route.
Yeah.
For me, it was just while we were raising our Series A, when we'd only raised 1.7 million. Before that, I got on a plane from Boston to San Francisco, and one of our competitors had just launched this rent payment product that we knew didn't work from an economic perspective, didn't fit our model. But like, to my point about getting distracted, I got on the plane, had 6 hours to stew in like a horribly turbulent flight about my competitor who just launched something quite sexy that, even though it didn't fit our model, was going to come up in all of my Series A pitches, and like it kind of threw me. So ignore the noise. It didn't matter. We raised. It was fine. It's always fine if you've delivered the numbers.
Yeah, and so I would say the point that was probably the most difficult for me at Expensify was everything's up and to the right, everything's great, with the exception of we couldn't explain why, and we were running out of money because we were just trapped into this Silicon Valley mentality of like, you just keep raising and spending money just because it's what you do, sort of thing. And I'm like, but it's fine, everything's great. There's always gonna be more money available so long as things are great, right? And I went into this round, and I just could not fucking close this round, even though it's like, business looks really cool and all that, but you just can't explain why. And why are you trying to raise money again? And I'm like, I'm not even really sure.
Seems like the right thing to do.
And but then I'm like realizing it's like, oh shit, I can't close this round, and I'm also not profitable, and I'm going to be out of money soon. Yeah. And then realizing there is no capital really coming to our rescue. We just need to get profitable right now.
And it's literally on you.
Yeah.
There's nowhere to hide. That's the terrible truth about being the CEO. It's like you can't hide behind anyone.
Yeah, exactly. But so yeah, it was a very, very difficult moment, but I probably would all agree. It's like when you get through to the other side, there is such a bright end to that tunnel. And like I would say the period after that moment was one of the highest morale periods of the company. It was tough. We all pulled together. We cut back salaries by 15%, and we stopped all hiring, and we just worked super fucking hard, and it was amazing. And it changed the entire culture for the better.
Awesome way to stop it right there. Positive note. Thank you so much for listening.
Thank you.
Thank you.
That was cool. Great. Thanks, guys. That was really cool.
Thanks.
Did David talk about what they do as a company?
I didn't get a chance, but I'd be
Okay.
happy to.
All right. So check this out. So David and I met a few years ago, and he was a mentor for an accelerator program I ran. And he's like, yeah, we're going to Croatia, I think that year.
Maybe,
it was. Anyway, so the entire company goes somewhere for a month out of the year. So this was cool. Back then you were 20-something people. Today he told me there are 110, and they did Uruguay?
Yeah, we did Uruguay this year. The year before, we did Croatia. We take the entire company overseas for a month. I cannot recommend it enough for everyone. It is such an amazing experience. These deals come together so well, you got to give it a shot.
Yeah, and so I don't know. I thought that was like one of the coolest things you can do for culture and for rewarding your team, and it works out some of my cost-effective.
Oh yeah, it's great because it's one of the most productive months of the year, and everyone just Airbnbs their house when they're gone. So it works out well. If anyone's interested, I'd be happy to talk about it. If anyone's really interested, you can contact me at jobs@expensify.com, and I'd be happy to talk to you.
Yeah.
So thank you all.
All right. So everybody having fun? Has this been interesting? Great. This is a labor of love. All three of the organizers, including myself, we have actual real jobs. And this is our little baby that we do once a year. And it is a shit ton of work, especially when there's 3 other conferences going on today, Google I/O, and so you have no idea how much work this was. But I hope this is interesting for you. We have our next panel. All 3 of these entrepreneurs have had a company that was acquired. So Jojo is CEO of Enroll Me. AJ, it says Para VC because he's now a VC, but he was founder of a company called Wedding Party, which allowed you to have your guests take pictures, and it was really cool, and that was acquired. And then Clarence is chairman of Progressly, but also founder of Venture.io, which is using data like app usage and really understanding data behind the scenes to invest in companies. And SC does a little bit of everything. I think she used to be at Facebook. Now she's managing the Angels Forum, and she's just written a book about product. So with that, you guys ready? Come on down, please.
All right, good afternoon, everyone. And thank you, Nima and team, for inviting us. We're going to start with quick introductions from everyone on the panel, and then we'll dive right into my favorite topic. From an investor perspective, it's really the difference between success and failure, whether a company exits or not. So we have lots of things to cover. Do you want to start?
Sure. Yeah, so I'm Clarence Wooten. Now I call myself a serial founder.
Hello, sir.
Hey. Part-time angel investor.
Panel before you just went on, so we're on schedule.
I think he's still mic'd up.
Houston, we have a problem.
Way back when I founded a company called imagecafe.com that was acquired 11 months after we launched by Network Solutions. Since then, I founded a couple other startups. I claim 4. Nima just mentioned them, groupsite.com, Progressly, and venturefund.io. I'm now based in Palo Alto, and a big part of the startup ecosystem here.
Awesome. So I'm SC Moati. I spent 12 years building products and companies. Now I'm spending most of my time investing. I also run a community for product folks and entrepreneur called Products That Count, and we have a bunch of community events that you might want to check out.
Hi, I'm Ajay. I'm a partner at Pear VC. We have a typo, not Pearl. Pear. We're a pre-seed and seed stage venture capital firm based here in Palo Alto. I've been doing that for about 2 years, but for the 5 years prior to that, I was a founder of a company called Wedding Party. Wedding Party was a consumer product in the wedding space. Ran that, got a ton of traction, and we ended up selling the company to Instacart, and then I joined the original people who invested in our company.
What's up, everyone? I'm Jojo Hidea. I am the founder and CEO of Unroll.me. We started it in late 2011 and then got acquired by Slice Technologies in 2014. We're based out of New York, and there are about 14 of us on the team, and we are still working for Slice, and we're very happy.
So Jojo, I'll start with you. I'd love to hear your exit journey, and starting with why you started your company, and then fast forward to how you exited, and then I'll have the same question for you, Clarence, and you, AJ. Just pick one company and tell us the story.
So
your company.
So for me, when we started this company, I was a senior in college, and I was actually studying to be a lawyer. I was studying for the LSAT, but myself and a few founders got together, and we were amazed by the technology space that you can build this one site and millions of people can see it. So we just got together, started a few companies on the side, and one of them was Unroll.me. And we were, we liked the idea of email management and felt like our email inboxes were always overflowed. So we went and started, the simple idea of, here are all your newsletters, let me unsubscribe from them in one shot. And then turned it into the Daily Digest where you could combine them all into one. And over the time, we had a lot of trouble raising money. Everyone said it was a tool, it wasn't a product. You're not gonna grow past 100,000 users. And we started skyrocketing on the user base. And I think at the time we were about like 1.4 million users, and we had to make a decision. Do we go and try to raise a round, or do we try to partner or get acquired? And that's when like the data in email started to become super valuable. And we were consumer guys, right? All we knew was consumer. We were young, right? I'm 27 now. So I don't even know how old I was at that time. I think it was 24. And there were a few companies coming after us that wanted to take our user base and create an intelligence business out of it. So we actually had a pretty crazy story where we signed a letter of intent with a different company and spent 3 months in the M&A process. And it didn't work out for various reasons, and I think there are some good lessons there. So like one is they wanted to replace the team. They wanted us to just rip apart the team. They didn't value what we built. They thought we were all very junior and inexperienced, and they wanted just to put their stamp on our product, and we didn't like that. But the main thing was that we didn't see eye to eye on what to do with the current team members in terms of taking care of them. I remember everyone was underpaid at Unroll Me. I think like engineers were making like $70,000, and they said they would take care of them. They told me that from day one. And then 3 months after, they said to me, as I was going on my honeymoon, this is the increase for each one of the employees, and it was like 70,000 to 75,000. And they sent out that email to each one of the team members. So like right then and there, I called my co-founder Josh. I'm like, we're not doing this. And we saw a week later that Slice got acquired by Rakuten. We called them up to congratulate them, and they're like, "You guys still for sale?" And we're like, I don't know. Like, give me a number, and give us the weekend to decide. So we gave them a number that we thought was too high. And in that number, I also gave salary amounts for each one of our employees, which was like almost 100% increase. And they came back and said yes to both. And I think the best thing that has been in our relationship of getting acquired is they're like, you guys do your thing. And you're talking about like Harpy and Scott, some of the founders of Slice have sold multiple companies. They're like partners in Eric Schmidt's, VC fund innovation endeavors. And they're like, we're not going to tell you what to do. You do your own thing. You know what you're doing. You built this up. We're here to support you. You keep your team in place. You keep your culture. You focus on the consumers, and we'll focus on the business side of things. And I've honestly learned more post-acquisition than pre-acquisition, where every team member is still there. We're still a very small team based out of New York, and now we have over 4 million users. So it's awesome.
Jojo, you said you learned more after the acquisition than before. So if you were going to turn the clock backward and replay that movie, like what would you do differently, or what would you do the same? What are the lessons you've learned?
So I think startup world is like a roller coaster ride, right? There are like ups and downs throughout the entire process. So I think every single piece in what we were doing was a learning experience. So I don't know if I would change anything per se. Like I think I would still do things the same way. I would just say is like, starting a company and getting it off the ground and getting 100,000 users is one thing. Scaling it to 4 million, like I thought you can always throw money at the problem if you have, I didn't know what scaling was, right? It's like you can't just like spin up Amazon instances and your product is gonna work, right? You need to like figure out how to partition your database and stuff like that. Maybe now looking back at it, would I've taken the chance ourselves, raise a big round and go after that business on our own? I think this worked out for us. I got an amazing mentor in Harpy who has taught me the ins and outs of business, the ins and outs of like, how you even raise money, how you grow a team, how much you care about your team members and growing them. And for me, the team is everything. And if you look back, right, it's like, again, I had no idea what the hell I was doing when I started this. Like, honestly, no idea. Our head of engineering at Unroll Me was an intern. Our head of product at Unroll Me was an intern. So I think just seeing the success of every member of the team, like I wouldn't have changed anything. Now it's just about what's next.
Clarence, you've started and sold many companies. Do you want to maybe share some compare and contrasting stories?
Yeah, I think, the startup I'll talk about is called imagecafe.com. It was actually acquired in 1999, which seems like a lifetime ago now. So it's certainly going to contrast these stories up here. But back then, I was a young entrepreneur. I wasn't even based in Silicon Valley. I was based in Maryland. And I read this book called Burn Rate, and it talked about a law firm in Silicon Valley called Wilson Sonsini. And it talked about them being the most powerful law firm in tech. So I went on Alta Vista, pre-Google, and found Wilson Sonsini's website. And I figured if I could get Wilson Sonsini to represent my company, they can introduce me to VCs because they represented most of the VCs. And I started in their attorney directory. I started in the A's, and I sent the same canned email to 4 attorneys there. It basically said that I'm the CEO of an East Coast-based e-commerce internet startup, and I'm looking for Silicon Valley-based legal representation and venture funding. Give me a call. Now, Image Cafe, just to fill you guys in, we were the world's first superstore of prefabricated website templates for small businesses. So we were very similar to what Wix and Squarespace is today, but we had a SaaS model attached to our business. So I think we were one of the first SMB SaaS companies on the internet. So anyway, make a long story short, the guy calls me back from Wilson Sonsini. and his name is Mike Arrington. And so this is the summer of 1998. So Mike and I became friends. He was a young associate at Wilson. He worked under a partner, a guy named Jim Strawbridge. Jim had taken Netscape public, actually, a couple of years prior, which really started the whole dot-com boom. And Jim, coincidentally, also happened to be from Maryland. So they decided to bring us on as a client, and we had no money, my co-founder and I. And so we negotiated a deal, which is common today, where they would basically set up the company, stock option plan, everything we needed, and if we were not successful at raising a venture round, we wouldn't have to pay. And that ended up working out. I was a student of the internet. I had watched a number of startups out here, such as Yahoo, et cetera, go from 2 Stanford students to multi-millions of dollars in investment from Sequoia. So, it was my mission to put together the perfect round. So I would fly out here, crash on Mike's couch, go pitch VCs, and they were all pretty much saying the same thing. They were pretty much telling me that I needed to be in the Valley. Coincidentally, on one of my flights out here, I got an ex-girlfriend who was a flight attendant to bump me up to first class because I was hoping I might sit next to an angel investor on the flight. And unbelievably, I did. I ended up sitting next to a guy, his name is Bill Daniels. He was principal at Bank Boston Robertson Stevenson at the time, and he was a captive audience. I ended up sort of spieling my whole vision for Image Cafe on that flight, and unbeknownst to me, he was an angel investor, and he set up several meetings for me. He wanted me to meet his friends and just share the idea with them.
Tell us your exit story.
All right, okay, yeah, this could take all day. But the exit story was, we were in the middle of putting together a $3 million Series A right after we had launched. We had raised a couple $100K before then. Draper, a firm in New York called Argentum, and Network Solutions was going to be our strategic investor. And that's what got them all to the table. I realized I needed Network Solutions as a partner because they had a monopoly on domain names. What ended up happening was Network Solutions kind of preempted the round and offered to acquire us. Initially, I said no, and then we started to run out of cash much quicker than I thought, and I hadn't gotten the round closed yet. So I went back and said yes, and thank goodness I did. So we ended up closing the round in November of '99. That was about 11 months after we had launched, and we all know what happened in mid-2000, the bubble burst. So I spent 3 years inside of Network Solutions doing an earn-out. My experience wasn't as pleasant as yours. It was more like a 3-year punishment. But at the end of the day, it all worked out, and that was my first exit.
So I'm hearing a pattern of, passionate team, a bunch of luck, a lot of hard work, and then an early exit, which matches, the story of my own company. You're an investor. Is that a pattern that you see with your portfolio?
I think it happens. When we invest in a company, we invest super early. So it can be 2 or 3 people in an idea, small checks, anything from a couple $100,000 to $2 million. But when we invest, at least at our firm, we're really looking for a long-term relationship. We're not thinking about, in the 2 years that I've been there, I don't think we've ever asked, who buys this company. What we think about is how passionate, how knowledgeable are the teams? Is the team in the market that they're going after? Are they sufficiently well positioned? Do they really understand their space? And how big is the overall opportunity? And that's really what we think about most.
Interesting. We invest a little bit later. We ask a lot about exits, and we look for the pattern that you described, and you described, Jojo, which is a relatively fast to exit. If you were going to think back and look at best practices of ways to attract potential buyers besides getting an upgrade on a plane, what are some recommendations or things you guys would share with the audience?
Well, really quickly, I think successful serial entrepreneurs do a couple of things kind of instinctively, which help them effectuate an exit. Ultimately, when you're building a business, you know who the large industry incumbents are who could potentially acquire you. I no longer believe you should build a company with the purpose of being acquired, because that usually means you're probably not a venture-funded company. But at the same token, while you're building your company, you should know who the players are. You should know who runs product inside of large companies that could be great strategic partners for you. who's on their board potentially, and try and get them on your company's advisory board, because oftentimes acquisitions come through partnerships, because partnership with a smaller startup and a larger company gives them a window of opportunity to sort of see exactly who you guys are and how you fit like a puzzle piece into their overall strategy. So most acquisitions aren't accidental, and instead of trying to sell your company, you want to be acquired. It's just like having a house and somebody knocking on your door saying, move out, right? Here's a check. You get a much bigger price than you would if you put a for sale sign in a yard.
How do you initiate a partnership? Like, are you talking to a corporate venture group, a product team?
I think you have to be naive. One of the great things about being an entrepreneur is that when you're naive and you haven't sort of spent a lot of time in corporations and you haven't gotten used to sort of hierarchy and rules, you become a CEO, you believe that you can call any other CEO. At least I did. I thought the minute I became a CEO, I could call Bill Gates. Hey, we're both CEOs, right? So that naivete will help you if you're hungry and passionate, find the individual you need to meet with and go directly towards them. So keep that, it's a blessing.
I'll add something. So, when I think about selling your company, the first thing that I think about is just having a good company. And that comes down to fundamentals. So I was running my startup for 5 years. Why 5 years? Because for the first 2 years, we sucked. And we were just a bad company. We didn't have the right team. We didn't have the right product. We had no idea how to build and iterate quickly. We didn't have product market fit. But then once we started figuring it out and once we started hiring the right people and figuring out our market, we started building the fundamentals to have a good company. And we started growing very quickly. And then when we did start having these partnership conversations, those turned into acquisition conversations, because when the partnership teams met our team, they were like, these guys are pretty smart. They have built something that's pretty interesting. And so I just don't think there's a shortcut to that.
So after you call Bill Gates or someone and they say, let's do a partnership together, what are your recommendations or advice for turning that partnership conversation into an acquisition conversation?
Okay.
Or how does that happen?
Yeah, so two things. First thing is, if you do call Bill Gates or whoever, I learned this the hard way. I was really naive. I thought that they would come propose a partnership to me. It's actually the other way around. Like, always go prepared with an idea of how you can work together. So I got that wrong the first couple of times. And then I think you're just really establishing a relationship, right? You have to get to know each other. Ideally, you can work together a little bit in the partnership. And the way that it turns into an acquisition opportunity is because they know you and they're aware of the timeline of your company, right? So I heard you guys were fundraising. And you were talking to other companies when you were doing when your acquisition actually went through. And the same thing happened for me, where we were talking to a bunch of people, we were raising money, and the people that we were close with, the people that we had partnered with, were kind of aware of it, and then they came to us with the acquisition opportunities.
So in other words, you're saying use your, to transform a partnership discussion into an acquisition discussion, fundraising conversations are a great way to sort of trigger a change, which is sort of what happened to you as well.
And what's also interesting with us is, we started our relationship with Slice, as trying to have a partnership with them. It didn't end up working out, but we already had a relationship with Harpy, with Scott, with Eric, with the founders of Slice, because they identified us as the biggest email panel early on, right? So as we were talking to them and as we got to, we got to know them through I would say 6-7 months before getting acquired by them, they knew who we were, they knew we had a strong team, and the partnership couldn't work out, financially it didn't make sense for both parties, but we were already 1 foot in the door. And then obviously it ended up making more sense to get acquired, and once they got money from Rakuten, it all just, worked out well. But I definitely think building that relationship, I think the beauty of the tech world is you can go up to anyone and talk to anyone, right? It doesn't matter if you're a huge VC, a huge founder, everyone is always giving advice and everyone is always talking. So going to events, I don't put myself out there. I don't just go up to people and talk to them. It's something I'm always still nervous to do this day. But what I realize in the tech world is everyone's an open book. Everyone will talk to you. Everyone is willing to help. So to do that early on in your startup career and in your startup life is very important because it'll open up doors and open up partnerships, which I think a lot of times end up leading to acquisitions.
It's interesting. We had a similar experience at my last company, but we were a little bit more intentional. Like we actually started having like very deliberate partnership and M&A conversations with folks, and then something completely serendipitous like what you described came out of that. You wanted to add something?
No, I was just going to say, if you're a small startup and it's early in your startup's life, it really needs to happen organically. I think when you're larger and you have metrics and you have lots of potential buyers, maybe you've ignored a couple of potential suitors in the past because you wanted to build the business bigger. It becomes a whole different ball game than it is when you're smaller and you start with a partnership type relationship. You certainly want it to happen organically. You don't want to go to them and say, "Will you buy me?" That is not the approach. It's just build that relationship, show how your startup will add value to what they're doing, and things tend to work out naturally.
So once you go down that path of partnership to acquisition conversations and you start, putting a few things on the table and the conversation all of a sudden becomes a lot more real, what are the terms that matter? What are the important things or mistakes to avoid when you're negotiating your exit? And I know you mentioned the first thing for you, which was the team. You guys want to share? Do you want to start because you're an investor?
So through my experience, we were talking to a number of companies about our acquisition, and the ways that people structured it, they were kind of different. So some people wanted to pay more money up front, some people wanted to do more on an earnout, some wanted to negotiate salaries, and I think someone gave me this advice, like you need to think about 3 things when you're selling your company as a founder. You need to think about your investors, yourself, and your team, and you need to decide which order you care about. And so for me, after thinking about it a lot and talking to my co-founders, we decided we had like a 9-person team, and we realized that what we cared about most was the team. And so we were talking to a lot of companies on the East Coast and some out on the West Coast, and when we could have made more money selling to the companies on the East Coast, but what we realized is that none of our teammates were actually going to move out. It was going to disrupt their lives in that way. It wasn't going to be companies that people would recognize on their resume, whereas the West Coast companies, people would. And so what we did is just try to optimize for our team, and we fought really hard for every dollar of salary and every stock option that we could get for our teammates, and that's something that I was really proud of through that process.
Is that thought process to put the team first, which sometimes can conflict with, investors and board members, is that coming from discussions with the acquirer? Like, how do you negotiate that throughout the process? Or did you have any conflict when you were negotiating that?
Well, I think for us on the Slice acquisition, we were on the same page right away, right? But I think as like a founder, it's like your team is everything, right? They're the ones that believed in you right away when you had this vision and everyone thought you were crazy. So they come first. And I think we were very passionate about that early on. Because if they're not happy, then how are you gonna live with yourself of doing something just for you or just your investor? Right? It's like they're the ones that bet on you early on. And I think to see it through, right, of like where it is now, that everyone that was on the team post-acquisition is still here, lets us, be happy. For me, one of the most important things in an acquisition that you have to think about is how are you going to set your company up, the company that's acquiring you, to be happy once you're gone, right? No entrepreneur is going to be there forever. So you want to have the track record of, right, we sold Unwomi to Slice. We went from 1 million users to hopefully 10 million users. It was a great, successful exit all around. So now the next startup we build, right, and we go to get acquired again, they know that, right? So it's like very important to set yourself up that you know that what you guys or what your team is going to be doing within the company is going to be successful.
I'll talk about a different aspect of it. Once you're acquired and the integration goes on, really understand what everybody's motivations are. Because it turns out I walked into a situation where there was an executive at the acquiring company who thought that I would be part of his P&L, and he would basically run my company. And it turns out I became his counterpart, and I had to work closely with him to integrate my company into the acquiring company. And unfortunately, you know, he put up a lot of roadblocks because he wanted me to fail with the integration so that he could come in and say, see, these guys belong under my P&L. And I didn't know that going in. So I wasn't accustomed to sort of those internal corporate politics. So it's real important to really, if you're a founder, to understand that that kind of stuff can happen post-acquisition. So, you know, don't necessarily envision yourself becoming the CEO of the company that acquired you, because there's a whole lot more you got to go through after the acquisition. So just, that's kind of a negative story, but it can't all be positive and rosy, because this is startup land.
I'm saying you're right. Like, it's like you go from controlling every part of the situation to having to step back, and now you have this whole other company on top of you, and it's not easy.
Right. And politics and everything else plays in. When you're a startup founder, you're typically above the politics because, you know, the buck stops with you most of the time.
Okay. One last question for you guys. 99% of startups get acquired for an amount that's under $100 million. How does that factor into fundraising strategy and raising your different rounds?
I'll be really quick. Yeah, I see so many entrepreneurs today get so excited when they raise a big venture round, as if that was an exit. That is, I mean, yes, you want to celebrate it internally because it gives your company the fuel, but every venture round you raise increases the hurdle in terms of what that exit needs to look like, particularly when it's a price round and a VC basically you know, puts a clause in it that says you can't sell unless they agree that you're going to sell. So that's the reason why, you know, oftentimes a lot of startups that raise a ton of money don't get to a successful exit because, as you mentioned, there's so many more exits below that 100 million threshold. So every time you raise a round, you should, as a founder, do a net present value analysis, right? You know, understand exactly how much post that raise your company has to be sold for in order for you to have a positive outcome. Because you may be getting acquisition offers that might be in the $50 million ballpark, and you have taken, you know, you haven't raised a ton of money. You know, you got to think really, really hard, particularly if you haven't sold a company before, whether or not you want to go for that first win, versus taking a $10 million funding round, which means that you have to be well north of 100 million before an exit makes sense, not only for you but for your investors.
Yeah, and it considerably reduces the number of companies that can afford to buy you, right?
That's right.
If I read between the lines a little bit on your story, your buyer would have wanted to buy you before, but they just didn't, you know, necessarily have the money.
Yeah, and I think if we raised a big round, we wouldn't have sold, right? I think that would have ended up screwing us over, right? Because then VCs want to see a certain, you know, exit, a certain return on their investment, and it limits you, right? And now it's like the cool thing in startup world to raise as much money as possible, but a lot of times that limits you, right? Because if you're a founder, you have a $50 million exit, you and your team are very happy, right? And that can set you up for the future. But if you go and you raise $5, 10, $15 million, and you have that valuation on you right now, your VCs want to see a huge return, and I'm sure you know that.
and not only that, but the outcome for, you know, founders and team members is also, you know, less and less attractive.
Yes.
Do you want to add something to that?
Yeah, I mean, very quickly, I think, you know, we always advocate people raise as little money as they absolutely need to get to the next step. And really, in that question, we're asking people kind of how well have they planned? Like, how well have they thought through what the various steps are to get from step 1 to step 10 to building their company? It's really simple. I mean, if you end up selling your company for like $10 million, it's better that you raise $500K and not $3 million. Right? And I think when we see founders, even at the seed stage, saying they're raising $2 or $3 million, we really question why they need that much money and what exactly they're going to be doing with it. And I think it's really important for all founders to think about why they're raising that much money.
Any final advice or a book or a newsletter that you think could be helpful for people who want to learn more about that topic?
So I'm all about the team. So there's a book, I don't know, I forgot who it's by, but it's called Who, and it's a lot about the hiring process, which I think is awesome. I think the main thing here, though, is just do what you love. Right? It's like I love to go, from the day I started on Roll Me, I love to go to work every single day. Right? And I'm still, it's I don't even know how many years later, and I still love going to work every single day. That's like the main thing. And I know that, seems kind of obvious, but if you don't love what you do, in the startup world, when things go bad, it's going to be very hard to go back up because it's a roller coaster ride. So as long as you love what you're doing, you'll be happy and things will work out.
I would just say that, startups are hard. So as you mentioned, I'll echo that, do what you love. And if you're building a startup and it's not in the consumer space, it's in the enterprise space or SMB SaaS space, go and sell your product before it's built. Focus on the design, the front end, sell it, get some customers before it's built, because it will set the tone for your company's culture, right? Because if you're thinking that I need to raise money before it's built, then it changes the dynamic. The cheapest funding is sales, right? So if you start off there, then you're going to be in a position to win long term. So my advice is to sell your product before it's built, get some customers, and everything else will then take care of itself.
Yeah, I agree with that. The one newsletter that I really like is the CEO Challenge, which talks a lot about structuring revenues and getting a lot of revenue strategies in. And then around exits, I look at Mattermark a lot. I think they're good. What about you?
The number one thing that I'd say is I think everyone thinks about money, but when it comes to this, don't think about money first. Think about building something of value, thinking something that customers and users really want to use. And I think if you do that and you're successful, that's how you're going to get to a successful exit.
Thank you, everyone.
Awesome. All right, so our next speaker is David Hornick. I don't know if you've seen